After that, after this, only one chapter, huh?
Yeah, exactly. After that,
Yes.
there is one more chapter. So the today's module will be looking at different aspects of anti-abuse uh, doctrine. So we'll be able to recognize the corporate tax advantage and ways to counter it. So this term corporate tax advantage is actually a negative term. We are going to look into it in detail, describe tax evasion and recognize how to penalize and counter tax evasion. How does FTA penalize it? We'll be able to describe procedures for filing returns. We'll be able to understand FTA's administrative penalties and how to appeal. Very, very important. From a practice perspective, how to appeal. So, Article 50 of the Decree Law, Federal Decree Law number 47 of 2022, which is the mother law of corporate tax in UAE. Article 50 is called General Anti-Abuse Rules. So this article applies to transactional arrangements if, having regard to all circumstances, it can be reasonably concluded that the entering into or carrying out of the transaction or arrangement or any part of it is not for a valid commercial or other non-fiscal reason. The key word here is non-fiscal. So when companies, move their place of registration from mainland to free zone, for example, just to gain that corporate tax advantage, it may be seen as a it may be seen as a fiscal reason. It is not a non-fiscal reason. Um, the main purpose or one of the main purposes of the transaction or arrangement or any part of it is to obtain a corporate tax advantage. Now, the first point was, an invalid commercial reason, which was not really because of the commercial benefits, but to avoid or evade tax. Actually, evade will not be applicable here. It is only to avoid tax because anti-abuse means the word anti-abuse refers to the abusing of law. So while the law may allow it, but the intention is to cut down on your taxes while playing with the provisions of the law in an unfair manner. So that's anti-abuse. And that is why tax evasion, which is essentially a crime, basically stealth, stealing of tax, that is not applicable here. It's tax avoidance. And that is the difference between tax evasion and avoidance. And the second part of this article was the main purpose or one of the main purpose of the transaction or arrangement or any part of it was to obtain a corporate tax advantage, which I mentioned earlier that it is a negative term. It alludes to uh, gaining unfair advantage. That is not consistent with the intention or purpose of the decree law. For Article 50 to apply, it must have been reasonably concluded that the transaction arrangement did not have either a commercial reason or a non-fiscal reason, which represents economic reality. And another thing was simultaneously, it must also be reasonably concluded that the main purpose of the transaction was to achieve a corporate tax advantage. Now, that corporate tax advantage, as I mentioned, can take multiple shapes. So there is discussion on this, aside from complex interpretation issues arising from the use of the words such as reasonably concluded, because this is open-ended, or valid commercial or economic reality or main purpose. These are all subjective terms. So the law does not define its intention or purpose, which the transaction arrangement needs to be consistent with it to be subject to Article 50. So what happens is, in case the Federal Tax Authority is put upon inquiry that some action or arrangement or transaction has happened, the intention of which is to either gain an unfair advantage or that transaction was not done because of valid commercial reasons, then they evaluate it in an open-ended manner. They evaluate it, and once they conclude that the intention was bad, intention was to avoid tax, that's when they take certain disciplinary actions. The meaning of transaction arrangement when analyzing whether a taxable person has carried out tax treaty abuse. Now, that's another very interesting angle which pertains to international tax law, international tax, whereby the double tax agreements come into play. So, treaty abuse sometimes refers, one of the major issues in the treaty is tax residence. So, sometimes entities may, organize certain arrangements in a manner to avoid tax residence in a country. So, this is one example of treaty abuse. It was considered by the OECD in their BEPS action report, which consisted of 15 action points basically. BEPS, you might have heard, it was an action report that was published, I think, in 2016 or even before. And because of the action report, the Model Tax Convention was also developed, and today 139 countries are signatories to that Model Tax Convention. One of the actions was action number 6 in that report, so which addressed that the different measures on how to avoid treaty abuse, double tax treaty abuse. In that report, OECD concluded that the words should be interpreted broadly and include any agreement, understanding, scheme, transaction, or series of transactions, whether or not they are legally enforceable. That's a very important point. So the spectrum has been kept very broad for this purpose. In particular, they include the creation, assignment, acquisition, or transfer of income itself, or of the property or right in respect of which the income accrues. So basically, under the treaty abuse, when any revenue authority evaluates whether a treaty has been misused, abused, they have their spectrum of looking at it is very broad. They look at all sorts of arrangements and the income that is affected by it, even the assets that generate or give rise to that income. These terms are also encompass arrangements concerning the establishment, acquisition, or maintenance of a person who derives income, including the qualification of that person as a resident of one of the contracting states. So even the person level and here the person may be referred to as an individual person rather than a legal person. So even these matters, where the person resides. Sometimes, if you look at the double tax agreement, they use place of primary abode or place of vital economic interest. So these matters are also brought into question to see whether because of that decision making individual or the controlling individual's residence or looking at other economic or technical skills and profile of that person, they can come to a conclusion that what has been portrayed by a company controlled by that person is actually not true, and the intention behind it is to gain an unfair tax advantage. In that case, the revenue authority can take a disciplinary action and impose taxes, or avoid that, counter that corporate tax advantage, unfair advantage. Example of an arrangement, that's a very good example. An example of an arrangement would be where steps are taken to ensure that meetings of the board of directors of a company are held in a different country in order to claim that the company has changed its residence. So, what is the importance of the board of directors? The importance of the board of directors is that actually it is the supreme executive body which runs the affairs of a company. So, if the board meetings are happening in a country, that company can claim that the effective management of this company is happening in this country where the board meetings are being held. However, the intention was just to change the place of residence, right, of that company. Why? Because poem concept, place of effective management, alludes to the fact that that place of effective management will be where One example is that the board holds its meetings there or resides there. But then again, there are case law available, which I have mentioned time and again. One was Australian case law, and another was in India. The case law related to the company that was incorporated in Sikkim. So in those cases, the revenue authority as well as court, they concluded that the because the place of effective management was uh, a country which was other than the one claimed by the company, the tax residence countries tax legislation was applicable, and the company was charged tax according to that other country where company's place of effective management was. One transaction alone may result in a benefit, or it may operate in conjunction with a more elaborate series of transactions that together result in that benefit. So, yeah, I mean, it can be an arrangement, it can be a transaction only. Main purpose, guideline. Now, when we talk about this expression main purpose, where did we read this main purpose? We read it that the main purpose of the transaction or arrangement is to avoid tax in Article 50. So what is that main purpose? How do we define, how do we draw the line that this would be seen as main purpose and this would not be? So that has been elaborated and addressed a little bit more. The main purpose concept is one which has growing acceptance at the OECD and at individual country levels to determine when a transaction or arrangement has been established for commercial or tax reasons. So let us look at it. Let us start these for example, the first point is that the report, that action report 6 of the BEPS, stated that when determining whether one of the main purposes of any person concerned with a transaction or arrangement was to obtain a corporate tax advantage. So, when as a result of their review, the Revenue Authority concluded that the original purpose was only to gain an advantage, corporate tax advantage, unfair advantage. It is important to undertake an objective analysis of the aims and objects of all persons involved in putting that transaction or arrangement in place or being a party to it. So naturally, that transaction will be seen in detail. What are the purposes of a transaction arrangement is a question of fact, which can only be answered by considering all circumstances. So yes, it is a very open-ended question. You have to look at it, and there are when once the Revenue Authority reviews it, or if in case you are a tax auditor, when you look at the circumstances of that transaction, you look at beyond what is visible, one would find out whether the original intention of the transaction or arrangement was to avoid corporate tax. It is not necessary to find another, this is the second, aspect or discussion point on the concept of main purpose. It is not necessary to find conclusive proof of the intent of a person concerned with a transaction or arrangement, but it must be reasonable to conclude. So the key point, the key word here is reasonably certain, or it can reasonably be concluded. After an objective analysis of the relevant facts and circumstances, that one of the main purposes of the transaction or arrangement was to obtain the corporate tax advantage. And I repeat, wherever you read the word corporate tax advantage, we should assume a negative connotation to it. So that's the corporate tax advantage. You can add one more word here, corporate tax unfair advantage. So that you can remember it. The action report confirms that it should not be lightly assumed that obtaining of a benefit was one of the main purposes of the transaction or arrangement, and merely reviewing the effects of an arrangement will not usually enable a conclusion to be drawn about its purpose. So, basically the idea is it should not be lightly assumed that obtaining benefit was one of the main purposes. It should not be presumed. You have to evaluate, you have to look at all the circumstances and then come to a conclusion. Where an arrangement can only be reasonably explained by a benefit that arises. So what is being said is the output or outcome. So one way of looking at it is what was the outcome of all of this arrangement. It may be concluded that one of the main purposes of the arrangement was to obtain a benefit. But after doing a transaction or constructing an arrangement, if the outcome has not substantially changed in terms of tax, then it would be reasonably concluded that the intention was not to gain a corporate tax advantage. But if it does, if it results in a corporate tax benefit, then the question will arise that whether this was actually the intention of this transaction was unfair advantage. Reference to one of the main purposes means that obtaining the benefit need not be sole or dominant purpose. So yeah, I mean, for example, companies moving from mainland to a free zone, for example, Javza, let's take the example of Javza. Now we all know that Javza is a port as well. What if there was a company who wanted to gain that commercial advantage of being in the proximity of the port? So when they move to the port area, when they move to Javza, which is very close to the port, and they are able to avoid their cost of transportation all the way from Javza to some other place in, for example, Sharjah mainland or Dubai mainland, that would have to be seen in context of the corporate tax benefit that the company is going to derive, and then the reviewer will come to a conclusion. For example, another point has been addressed uh,
So,
regarding main purpose. Yes.
so I just one small question. So, based on your examples, if let's say a company is just moving to a free zone from mainland, and let's say it's not for the benefit of, let's say, using the port, so would that be construed as taking as an unfair advantage, being to to pay tax at 0% for a finance for a free zone, or no?
Yeah, so if the entire objective of it was to avoid tax, um, uh, because if they were in mainland, there was no cost saving involved that when they moved to Javza, and the only thing that changed was their tax position, then it is more likely than not that it will be seen as corporate tax advantage. Abbas, it will be seen as if you have other
Um, but
if you
then would
have
it be an unfair advantage or just an advantage?
unfair, it will be seen as an unfair
Unfair
advantage.
advantage. Okay,
It will be
okay,
seen as an unfair advantage. Yes. So that is why
okay.
there are so many companies that have moved. From a practical perspective, I'm telling you, I've advised quite a few clients who were into trading activity, purchasing, and interestingly, the merchandise was mostly coming to Javza itself. And it was a clear case that moving to Javza, they will not only gain that commercial benefit of proximity to the port, but also Javza has its own internal advantages and benefits as well. So if warehouse, proximity of the warehouse, for example, or getting that higher credibility of being in a designated zone. Because of that, we were able to see that, the yes, there would be an advantage. Qualifying income would be generated, but the benefits, commercial benefits outweighed that advantage. So again, it's a very open-ended question, but if let's look at it from another angle as well. If you know the economies stopped companies which were operating in mainland, economies like UAE stopped companies that were operating in mainland at the inception of corporate tax, then probably it would defeat the very purpose of having this qualifying regime, right? So that will also be seen in coming to a conclusion regarding any such matter. But yes, one very important aspect is the timeline would matter a lot. If those companies which made these corporate structural changes at the beginning of the corporate tax. Even now, I mean, it is the first return that is due, and quite a few companies which have come to understand the this matter, that the qualifying regime is there, and if they had moved in a timely manner, they would have saved tax. From a practical perspective, I think you are also a tax practitioner, you would understand it. Companies would find a way, one way or another, and even sometimes the companies would prepare business cases around it to demonstrate that the economic benefit or commercial benefit outweighs that tax benefit. So that, tomorrow if the Article 50 is applied to them, or even a review of corporate tax advantage is performed by federal tax authority, they should have a study available with them that they did this before moving, and due consideration was given to anti-abuse.
Okay. Cool. Thank you.
So, as we were looking at the third point, for example, a person may sell an asset for various reasons, but if before the sale the person becomes a resident of a country other than the UAE, and one of the main purposes of doing so is to obtain a corporate tax advantage. This is just an example. We will have to dig deep into it as to whether actually sale of an asset to a non-resident has any major corporate tax implications. I cannot immediately think of that, but just for discussion's sake, what we are looking at it. Then, notwithstanding the fact that there may also be other main purposes for changing the residence, such as facilitating the sale of the property or reinvestment of the proceeds of the alienation. So, the whole point of this example is that assuming that there was a sale transaction of an asset to a person, to an individual, and that person changed his or her residence from UAE to another country, just to gain a corporate tax advantage. Then, and if it was reasonably concluded, when we say reasonably, it means it is not a conclusive. It's not conclusive evidence. It is persuasive evidence. So, if it was if enough persuasive evidence was available that this action was performed only to save or cut down on the tax in an unfair manner, this will be disregarded by FTA, and the person will be assessed as if he were a resident of UAE. In an important statement, the action report confirmed that a purpose will not be a main purpose when it is reasonable to conclude, having regard to all relevant facts and circumstances, that obtaining the benefit was not a main consideration and would not have justified entering into an arrangement or transaction that has alone or together with the other transactions resulted in the corporate tax advantage. As I said, if you recall, Abbas, that quite a few major companies, when if they make this move of have shifting their operating facilities from the mainland to, for example, Javza or Kizad or other, Hamria, for example, they would need to prepare a study actually, and there will be a monetary simulation as well, whereby incremental cost would be displayed, and it will reveal that the corporate tax advantage that they are gaining is relatively a very, very, it's a much smaller portion than the commercial benefit that they would derive because of this move. And that kind of a study would evidence or justify their move from mainland to that free zone or designated zone. Now, the next topic that we are looking at is the corporate tax advantage. Anybody else has any questions until this point? Corporate tax is tax imposed by the decree law 47. I think we by now everybody remembers it, that the law number is 47 that was issued in 2022. For the purpose of this, this
Yes,
article.
excuse me, I have one question.
Yes, please.
It's moving from mainland to free zone, then that is for obviously for the tax advantage.
Yes.
And then will it be considered as abuse or what?
Okay. That's what we were discussing. I will repeat, Mr. Nozer. Uh, okay, let me ask you a few things. Like, uh, moving from mainland to free zone will have two types of consequences, right? One consequence is that chances are that the tax will be reduced because of the qualifying free zone
Okay.
regime, right? This is now what would you call this benefit? I'm not using the word advantage, I'm using the word benefit because benefit is a neutral word, right? So when you use the word corporate tax advantage, it has a negative sense to it, negative connotation to it, right? So the question would be that okay, there is a tax benefit, correct? This would you call it commercial or fiscal? Mr. Nozer, you need to mute one of the devices. Uh,
Okay, okay,
you have two devices, one should be muted. Okay,
okay.
right. So my question is aiming to benefit from the qualifying free zone person regime so that you don't pay tax. You pay zero tax on your qualifying income. Would you call this benefit a commercial benefit or a fiscal benefit?
Fiscal benefit.
Fiscal benefit. So fine. That is one aspect of your study. You have to do a study. Okay. So first point is identification of the fiscal benefits. The fiscal benefit is that in mainland you are paying X amount of tax. Let's say 100,000 dirhams of tax per annum. Okay. And by moving to the free zone, that 100,000 dirham will be gone. Correct? That's a fiscal benefit, quantification of the fiscal benefit. But in addition to that, the move would result in major severe cut down on your transportation costs, right? It will also result in easily obtaining a bonded warehouse in Javza, right? And the warehouse that you had in the mainland, you would consider selling or renting for that matter, or there would be other strategies as well. So the monetary impact of those aspects would also be considered, right? So it will actually be a forecast of the incremental cash flows. There will be some inflows, some benefits, monetary benefits that will happen because of this move, right? One intangible benefit would be moving into a custom compliant zone that gives you higher credibility, right? There will be some facilities available in Javza that are going to help you do your business better as a member of the Javza. All those benefits would need to be collated and described properly in the report. And based on that, you can, if this evaluation reveals that the commercial benefit outweighs your fiscal benefit, and it is clear that the intention was not only to get the qualifying free zone person status, then this move would be seen as the intention for this move was not to gain the corporate tax advantage. So the whole point is that while making this move, both aspects, the commercial aspect and the fiscal aspect, need to be considered and evaluated. And the conclusion should be that the commercial benefits outweigh the advantage of the fiscal benefit. You get my point, Mr. Nozer?
Yes. But the commercial benefit we can't quantify. We can't say the within year or two we will get the benefit. But the fiscal benefit we can quantify.
Yeah,
And in that
you're
case,
right.
we need to quantify in the monetary terms, or we can just justify in the future benefit also as well.
Yes, you are absolutely right. There can be some the intangible benefits can be there, like branding aspect of the company can be there, the higher level of credibility because of which there is likelihood of getting more business that could be there. So yes, I totally agree with you. There can be a situation where the only apparent quantified monetary benefit would be the saving in the tax, but then the intangible benefits which may reasonably not be quantified, but they would need to be there on the report, on the evaluation report or that internal memo, business case, where you have identified that while there is corporate tax benefit because of this move, but we are of a very strong view that the other benefits, intangible benefits, which cannot be translated into monetary figures at this stage, uh, we are of a very strong view that this is going to give us a much larger monetary advantage to do our business better. So that will even still be considered by a federal tax authority. It is not that it will be disregarded. Absolutely not. This is a this is the ground reality. Okay, so it can
Yes,
still defend the action of the company by moving to the to a free zone such as Java. I hope you got the answer.
yes, yes, yes.
Okay, but just to as a key point, I will tell you that there has to be this type of an exercise done for any company that is moving from mainland to free zone, for example, because this is the biggest thing that is happening, that has happened over the last all 2 years now.
Is like I can tell my personal example. I moved from Australia to here, Australia to Qatar, and the Australia has a rule that the if I am like resident of Australia,
Mhm.
Australia I have to pay taxes on my Qatar income also.
Hmm.
But if I been out of the country for 6 months in a year, then in financial year out of the country for the 6 months in another country, and then whereas I have to provide, I have to prove my the I am living here like a permanently. I need to have a rented apartment or house, or my family also like moved with me here, and then only they will accept that you are not resident for the foreign income.
Right,
Okay,
right.
then sometime we can move for the family reason also. Will it be acceptable for the this one?
So yeah, a good question. I will tell you the answer. In even if you remember, I had mentioned that the double tax agreements
Yes.
supersedes domestic laws. If you recall this point under the Vienna Convention, right? So if
Okay.
you look at I'm sure the corporate tax law of Australia also addresses it. But even if it does not, you will find this in the double tax agreement between Australia and Qatar, and most of such double tax agreements always address place of primary abode, place of vital economic interest, etc. And if the move from Australia to Qatar, if the original intention was not to save on tax, if the original intention was not to only gain the status of non-resident, right, then it will be seen as a non-fiscal reason. But if
Mm.
you openly tell the authority that no, my only intention was to gain the status of non-resident so that I could save tax, that will be seen as a fiscal reason. And if
Mm.
tomorrow this is revealed in front of the Australian tax authority, then that
Mm.
advantage that you are getting because of becoming a non-resident, that will be taken away.
Mm.
Okay. So, anyways, the place of economic interest or primary abode, etc., that also has their interpretation. For example, does the person have a property here, owns a property in Qatar, for example? If you have, that's a very strong point. I mean, if somebody who doesn't want to live in Qatar and only getting that non-resident status, why would he go for buying a property there, right? Even the marriage matters. Like this happened in Israel. The Israeli courts gave a verdict on this. This has been addressed in the Toli book that was published by Toli. It is quite expensive book, I think, but they have mentioned this case law where the court decided on the base of the marital status and etc. and the children etc. Because of that, they said that the place of primary abode is Australia, and that makes is Israel, and that makes the defendant a tax resident of Israel. So these things are there. These things are considered. For the purpose of this article, a corporate tax advantage includes, but is not limited to the following. So now some examples of corporate tax advantage are being given. A refund or an increased refund of corporate tax, right? This is a situation where if it were calculated fairly, the refund would not be due, or because of a misuse of the law, the amount of refund has resulted in increase. That is an undue advantage. Avoidance or reduction of corporate tax payable. Naturally, this is the other flip side of the coin. Rather than whatever would have ordinarily or fairly be due in terms of corporate tax, that was reduced because of misapplication of law, or will become due for payment to federal tax authority, that will be seen as a corporate tax advantage. Deferral of payment of corporate tax or advancement of a refund of corporate tax. So cash flow, the manipulation of cash flow related to corporate tax to your advantage, timing of the cash flow to your advantage. If it is an outflow, deferring that outflow, or if it is an inflow, preponing that inflow, unduly doing that will become a corporate tax advantage. Avoidance of an obligation to deduct or account for corporate tax. Trying to create such arrangements where your status as a withholding tax agent is avoided, for example. So all of these are examples of corporate tax advantage. So same thing is being repeated, result in tax refund or increased tax refund, reduction in unfair reduction in the corporate tax payable, or even the refund as well. The tax procedure law of 2022, which became applicable or effective from 1 March 2023, that also addresses this. This sounds very much like the definition of tax evasion in Article 25 of the Tax Procedures Law, namely deliberately failing to settle any payable tax. So deliberately failing to settle the payable tax has been raised to the level of tax evasion under the procedures law. If it is, then which of the offenses it is? Corporate tax advantage or tax evasion? Sorry, you're saying something?
Okay. Yes. If the company LLC company, they don't declare tax properly, then the FTA is going to fine the penalty. Then who is liable, company or director?
So there is a concept of responsible person in the corporate tax law. So the shareholders are primarily responsible for the company. Okay, so the directors are responsible for the company. You might not find the article written in the corporate tax decree law, but in tax procedures law you might find this. The same has been alluded in VAT decree law as well. Responsible person. So shareholders, directors, absolutely. These are, as a matter of fact, key office holders will also be responsible. So all of these persons are responsible person. I faced one case during 2023 and early 2024 where two of the persons, one was the head of finance and the other one was a general manager, and they were not even shareholders of the company, but just because of the fact that their names were appearing in the trade license, they were facing the music of VAT law that was not settled, penalties that were not settled. So,
It's excuse me, it's not settled mean they have declared or they are not declared.
there was penalty imposed on the company.
Uh,
Uh,
the
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 company did not pay
the
attention to
penalty for the
yeah,
declaration income or payment.
penalty for the mistakes that they had done. Okay, some I can't disclose too much, but they had done a mistake in their calculation of the VAT, and that was that Pandora box opened up. An assessment was performed by the Federal Tax Authority, and the company was penalized with heavy penalty, and they
Mm.
avoided it. They delayed it. They didn't pay enough consideration to it, and it kept piling up. If I can tell you that the penalty figures was six-digit figures that was imposed on them in 2018, and by 2023, that six figures had become seven figures.
Mm.
It was unsettled, and even wrong advice was given by some, one of the major, top 10 firms here residing in UAE. And the funny mistake that they did, according to the advice of one of the tax very senior persons, was that they filed a voluntary disclosure after the assessment was opened up. So it
Mm,
is
mm,
very
mm.
crucial
You
to
can't do that, no? You can't do that.
do. After
After
the
the
assessment on it.
assessment, you can't amend it, no?
So this is the thing. Responsible person takes a very wide definition. Those people whose names are reflected on the trade license, they are also responsible persons. Okay.
But Australia, if you don't declare your tax liability, and then you are personally liable. If you declare the liability, then the company is liable. Then when you go for a bankruptcy, then they can't touch your personal asset
Hmm.
as long as you have declared your the taxes or the VAT or whatever, and then
Right.
they can't touch your personal. If you don't declare, then they can touch your personal asset also.
Right. Right. Right.
Is it similar to UAE or what?
No,
Are they?
in UAE, unfortunately, it is more stringent because the law is relatively new here. Australia,
Mm,
UK, they are very, very mature tax jurisdictions.
mm, mm,
There the laws are more refined. Here it is a bit
mm,
new. Probably give it a few years, maybe 10 years until the law matures more, transparency, more
mm,
fairness would come. So
mm,
probably but anyways, that's the ground reality of it. So that is why, if you remember, in UAE, there used to be a provision in the mainland that a local, a citizen of UAE should be reflected on the shareholding pattern. At least 51% of shares should be held that by that person. Even later on, that was made a kind of a figurehead kind of a situation by signing parallel trust deeds, but that started changing as soon as the VAT law came into picture, and then corporate tax law, and those shareholders, they started exiting, afraid they started exiting, that our
mm,
names are 51% appearing here, and if the company, after earning all the money, if they just simply run away and not pay tax
mm,
liability, we will
mm,
be caught.
mm,
So those
mm,
51% local shareholders who are getting only like
mm,
10,000 dirhams
mm,
per year just because of being there on the trade license, they started as,
mm, mm.
exiting in UAE. So anyways, one of example is result in tax becoming payable in the year or period later. So that is the cash flow aspect that we addressed. Manipulating the cash timing of cash flow in your favor, tax cash flow. Another example was result in taxable person not having to deduct uh, corporate tax or account for it. So obligation to deduct or record tax. Somebody creates an arrangement where his status or the requirement of withholding tax, or even booking it into their books is avoided. RCM. One example would be if you are importing goods into UAE and you using a third party to do that, and the third party says, no, we are going to do it, but you record it. It will be a fault on their part as well, because importer on record matters here. The importer on record has to record the tax. Similarly, one more situation in the VAT law is disbursement versus reimbursement. There is a very fine line of difference drawn there. So if it is disbursement, that disbursement is done on behalf of another person, where all the risks and advantages are with that ultimate beneficial owner. That person has to account for the VAT obligation. So careful attention needs to be paid to determine whether a taxable person is responsible for deduction, or at least accounting for the tax obligations. So some examples have been quoted. The following scenarios are examples of corporate tax advantage. A taxable person which is actually entitled to 50,000 dirhams refund, but a transaction arrangement manages to make the refund 75,000 dirhams. Transaction or arrangement. This may be a corporate tax advantage. So this change in the refund amount, when it is are orchestrated by misapplication of law, that will be seen as a corporate tax advantage. A taxable person enters into a transaction using a loss company to reduce the tax on an income stream. This may be corporate tax advantage. So you know that there is a loss-making company. If I used that company's platform for this transaction, because it is a major transaction, my tax exposure would stay reduced. So if the original intention or the main purpose was this only, then this is a fiscal reason. This is not a commercial reason, and it will be disregarded by FTA. A taxable person adjusts the payment date on a service fee so that the amount is booked as income in a tax period 1 year later. Very clever way to defer the tax outflow. So just change the date of the invoice so that it falls in the next tax period. So this will also be seen as an intention to defer the payment of corporate tax, and it will be seen as a corporate tax advantage. Now we are looking at Article 50, where the provision of Article 50 apply to a transaction arrangement. FTA may make a determination that one or more specific corporate tax advantages obtained as a result of the transaction arrangement are to be counteracted or adjusted. So FTA has different modes through which it can disregard that corporate tax advantage and impose tax obligation on the taxpayer. This clause provides that the FTA with a right to counteract. Mr. Nawzer, can you mute, please?
Okay.
This clause provides the FTA with a right to counteract or adjust a taxable person's taxable income, but does not define the circumstances in which that right may be exercised. So, counteracting or adjusting a taxable person's taxable income has been defined, but it does not define, naturally it is impossible to define circumstances, because every case will have its own varied economic and business circumstances. So it is not possible to account for everything. It is likely that FTA would need to consider each of the provision in Article 50, Clause 5 before the decision. So all facts will be considered. If a determination is made under Article 50, Clause 3, the FTA must issue an assessment giving effect to the determination, which may include allowing or disallowing any exemption, deduction, or relief in calculating the taxable income or the corporate tax payable or any part thereof. So, allowing or disallowing the exemption or deduction, etc. Allocating any such exemption, deduction, or relief, or any part thereof to any other person. So, FTA may conclude that this exemption that you have claimed actually it applies to another person. So, recharacterizing the purpose of the decree law, for the purpose of the decree law, the nature of any payment or other amount or any part thereof. One very good example would be where the shareholder or the owner has given a loan to its own company. Shareholders can give loan to their companies, but and on top of it, they charge interest on it as well, right? So, do you think that interest would be acceptable immediately by the FTA? They are going to look at it. They are going to look at various aspects of it. What is the size of the company? Was this loan actually needed in the first place? Secondly, okay, fine, if this were a loan, can we compare it to a bank giving this loan? Would the bank give this loan in the given circumstances? So once FTA concludes that, although yeah, the shareholder has called it a loan, but effectively it is equity. It is not loan. So all the interest that the shareholder charged to the company, that interest will be recharacterized as dividend or drawings of the shareholder. So that's the example of recharacterizing. Disregarding
Excuse
the
me, excuse me. What about the other side of that? They say that the shareholder is drawing the money from the company, and then that money he has to pay interest or what? Excess of his profit. Then without taking the dividend, he take the money.
right, good question. But again, the exact same rules will apply. Like if the shareholder see, corporate tax is a fair treatment, framework. So if you are not allowing a shareholder to charge interest on the loan, is it fair to allow to charge interest on the drawings that the shareholder makes? It would not be in the as I stated earlier, the circumstances would matter. Now, take the example of a listed entity, for example, right? So, if it is a listed entity or a very highly public regulated entity, um, in that scenario, there are regulators sitting on top of it who are looking at it. And if let's assume for a second that the law allows shareholders to give a loan to that listed entity, which is already highly regulated under the listing regulations, right? So then the situation will change. Then this lending transaction would be subject to huge scrutiny. Even the this lending would need to be substantiated by a proper loan deed with terms of repayment, EMIs, the interest rate that would be charged. So, circumstances change. As I say earlier, it depends on the size of the company, it depends on the circumstances as to what would be done. But for smaller entities, SMEs, usually the revenue authority of the world, they don't allow or accept that shareholder loan usually as something that would qualify as a proper loan that would attract interest. So these things need to be paid consideration, and vice versa. Drawings would not also attract interest on it. I hope you got the answer. Okay, so the next one is disregarding the effect that would otherwise result from the application of other provisions. So, some uh, as a result of the review, as a result of the assessment, FTA may come to a conclusion that some other provisions that were becoming applicable to the company as a consequence, as a side effect, or as one of the main effects of our review, those other provisions would also not be applicable to the company. So that could also be possible, and can make compensating adjustments to the corporate tax liability of any other person. Why? Because transaction would ordinarily happen between two persons, right? And FTA is performing the assessment or review of one taxable person. and they conclude that some adjustment to the revenue, for example, needs to be made. Now, how did that revenue come from? One person's revenue is other person's cost of sales. So if FTA is recommending one adjustment to the seller, the corresponding would go into the books of the buyer, right? So that's what is called a corresponding or compensating adjustment. FTA may reach out to the other person and also request them or instruct them to make the necessary adjustments. By making a determination, the FTA may disallow or allow a deduction or relief or allocate to another person the exemption or relief. This we just discussed. Deem an amount to be something other than that which the taxable person defined it to be, as the example of dividend versus interest on shareholders' loan. Disregard the effect that the payment would have, but for the determination. So one effect or corporate tax impact was accruing, FTA may disregard that. And lastly, it may adjust the corporate tax liability of any other person as well by way of a corresponding adjustment or compensating adjustment. I think this will be a repeat, but anyways, let us read it. The manner in which the transaction or arrangement was entered into or carried out is important in this regard. It is important to consider whether by way of the scheme was formed or implemented can be seen to be contrived to obtain the tax benefit. For example, it would be relevant if there are steps in the transaction arrangement that would not be accepted to be expected to be found in a more straightforward method of achieving the outcome. So this word contrive means, cleverly thinking and designing something. So if FTA concludes that this is a contrivance to avoid, corporate tax obligation, then this will be seen as an abuse of the law.
Sorry, can I ask a question?
Yes, please.
So if let's say there's an interest expense in the books which is arising due to unwinding of a liability. Let's say there's like a you have those let's say there's this liability for a company. I forgot the word for, where basically you have to sort of, if let's say if a company is a mine and they have to got this liability in the books where they have to bring the area back to its normal place, normal condition, let's say, after the mine has been used. So they basically got a liability in the books as per IFRS, and the liability will obviously be unwinding in the books with an interest expense. So would that interest expense be considered as a valid expense for the purposes of tax law, or would that be added back to the income? I forgot the name of that liability. There's that
That
word for it.
liability,
I think it for the IFRIC one. I think.
yeah, I'll tell you
Forgot.
the name. I'll tell you the name of the liability. It's called constructive obligation. So,
Not exactly that. Not exactly concept of obligation. It basically falls under IFRIC one. But okay, regardless.
right. So, anyways, the I can give you a broad answer around that. So, to begin with, multiple aspects need to be considered here. First of all, since this is it can happen by way of a constructive obligation, but it can happen by way of a statute as well, right? Above. Uh,
Yes.
it can happen by way of statute as well. So the
Yeah.
statute may require that company, then it will no longer remain a constructive obligation. It would become a binding obligation on the company. And as you rightly mentioned, the question here is not about the obligation, but the interest, unwinding of interest that would accrue. The answer to that would be that the FTA is going to refer back to IFRS first of all, after having referred to the interest deduction limitation that is there in the corporate tax decree law. There are multiple provisions that have been laid down on the interest deduction limitation. So we will have to do a detailed analysis of those provisions, and we will have to look at it as to whether the interest that is accruing in the books, does it fall into the category of the interest that is identified there. There is two types of interest deduction limitations that have been laid out in the UAE corporate tax. One is the general, and then there is specific as well. So we have to refer to those. If those provisions are silent, right? If we are not able to conclude with the help of those provisions in the corporate tax law, then the only place that would be the point of reference to make a conclusion on this would be the IFRS. If IFRS allow the unwinding of interest, and if it is in line with the IFRS, and it is not contravening with the deduction limitations, then that will be an acceptable deductible expense.
Okay,
Does
but
this,
then,
uh,
but if you think about it, this expense is not really of a revenue nature, right? It's more of a capital nature expense. So should that still be allowed then, if you think of it from that angle?
let me understand how, why would you say that this is a capital nature expense? Can
Um, yeah.
elaborate
So
more?
basically, this expense is not really directly attributing to your revenue generation. It's more because since you are, sort of doing the activity of, mining, and then as per law, or you have to, you sort of bring back the the area to, its normal,
Okay,
yeah.
let me ask you a very easy solution around it. When you unwind that interest, that unwinded interest expense or charge, is it going to land above the line or in the OCI?
It's not going to the OCS, it's going to P&L.
Then that's it. That's your answer. If it lands into
Okay.
your P&L, then it will be accepted as a deductible expense as long as
Okay.
it does not contravene with the general or specific interest deduction limitations. There are provisions provided there. If it does not affect that and it lands into your profit and loss account, and if the corporate tax decree law is generally silent on that very special treatment of this, then as I said earlier, for it's not only for this matter. I'll tell you something broader. For there are a lot more aspects similar to it. This is only one example. There are quite a lot of other things that have not been addressed very specifically in the corporate tax decree law. All of them, point of reference has been provided as IFRS, and FTA will accept the treatment recommended by IFRS.
Okay. All
Yeah.
right. Understood. Thank you.
If you are still not, if you feel that this, we can have a separate conversation on that. That should not be a problem. You can share any specifics if you like, but the
Okay.
general rule that is what I have just explained to you. We will
Okay.
have to look
Okay.
at
No, it's clear.
Okay. It is important
Okay.
to consider,
Thank you.
okay, as we were looking at it, for example, it would be relevant if there are steps in the transaction or arrangement that would not be expected to be found in a more straightforward method to achieve the outcome. So, contrivance, yes, we discussed that. The presence of these steps adds weight to the view that the purpose of the transaction or arrangement was to obtain the tax benefits. So, that detailed analysis whether a contrivance was intended or not, that will help us to determine whether tax benefit was intended in the first place or not. An example could be the interposing of a company which lacked any reason for being other than to create a corporate tax advantage or a round robin finance arrangement that was about generating tax benefits rather than providing funds for business activity. Yeah, I mean, lending, especially, intra company, intra group lending, it's a famous tool that has been used historically to book in excessive amounts of interest in subsidiaries or group companies' books. And this is a clear-cut way of tax advantage. Some would even amount it to tax evasion if it was done with with a clear intention.
But interest charge should be arm's length interest, huh?
Yeah, so see I'll tell you, Mr. Nazar, sometimes those who have started to look at it, they may their entire focus may be on interest. But those people who have thought more about it or dealt with these type of transactions, their first question would not be interest. Their first question would be the principal.
Okay.
You know what I'm trying to say here?
Mm.
I mean, the first question that would start is whether in the first place the very loan was needed at all or not.
Mm.
Or if it were needed, how much amount of it were needed, right? The
Okay.
benchmarking would come into play. I mean, okay, fine, it was needed. Okay, we did the analysis, we found out, yes, loan was needed by. But can you go to the bank and actually get that loan, that particular specific SME? If you went to the bank, bank would look at your financials and other things and say, we are very sorry, this is too high a risk, and you don't qualify for this type of a facility. And the same answer you get from 10 banks. You know that it is not possible for this company to get a loan from the bank in the first place. Would you still call it a loan in the books? Right? So many questions come in, Mr. Nazar. Interest will only become a consequence of these fundamental questions.
Okay.
Okay. Form and use, form and substance. The form and substance of the transaction or arrangement. This subparagraph considers beyond form of a scheme to the substance of what is being done. So I think even in our childhood, when we started off studying accountancy, we read something called substance over form, right? So same thing is applicable here as well. While the form may suggest one particular arrangement, maybe a loan or maybe a sales transaction, but if you really lift that veil, corporate veil, and look behind the scene, you might see a different story. The substance of that transaction or arrangement may be different. So, in short, the whole point is that while deciding whether a corporate tax advantage has been assumed, we have to look at the substance of the transactions as well. Timing of the transaction or arrangement. One very good example will be those companies moving from mainland to free zone, right? At the moment, I think you guys, other than Mr. Nazar, those people who are here in UAE might be aware about the influx or the level of movement that happened. I can tell you that some of my friends who were sitting in places like Javza or Izad or especially Hamrina or Ajman Free Zone. They said that our daily target of registration of new companies, can you imagine? Daily target was 100 companies in the earlier days. That was the quantum of movement that was happening. Do you really think that all those, 100 companies per day were moving only because of the economic advantage? What is your view, Mr. Nazar? Were those 100 companies per day moving because of only economic advantages to free zones, or was it because of the fact that the qualifying free zone regime person was introduced? Qualifying free zone person regime was introduced. It was because of the tax advantage. So timing is relevant here. So we can be, I mean, even going forward also, it is a dynamic thing, and hopefully we are going to see quite a lot of things coming in. One big area is withholding tax. We don't know, but who knows? Maybe in the next couple of years or so, we might find that rates of withholding tax have been introduced in UAE. So timing may be important of sudden change in an arrangement. So that needs to be carefully examined. So I'm not going to go into a lot of detail of this. Okay, let's read this last one. An example would be if a transaction or arrangement was entered into by the taxable person on 25 December 2024, when that person's tax period ended on 31 December 2024, just 5 days before the year end. and the transaction or arrangement ceased on 10th January 2025. Mr. Nagar, can you mute, please?
Yes.
Right. So you can see the dates here. It is very evident that only for 15 days a certain transaction or arrangement was performed. Why would that be? That's where the tax auditor would be put upon inquiry. And they would be inclined to think that it is quite possible that this transaction was done only to gain a corporate tax advantage. Okay. Change in financial position of taxable person. Any change in the financial position of the taxable person subject to corporate tax that has resulted, will result, or may reasonably be expected to result from the transaction or arrangement. So, this could be one of the uh, areas where a tax auditor or a revenue authority may be inclined to, dig deep into the possibility of a tax advantage. The inquiry must focus on identifying whether there has been any real change to the person's financial position, or whether the change directly following the scheme was counteracted by a countervailing benefit or expense to the taxable person in a related entity. The more a person's financial position changes, the less likely it is that the transaction or arrangement was a corporate tax advantage. So, it has to be seen on a reasonable timeline. Even if there is at the year end, suddenly there's a financial position change, the debt equity structure suddenly has changed, or otherwise, then we have to look at a slightly longer timeline to determine whether this change sustained or it was immediately reversed. It will reveal whether a corporate tax advantage has been achieved. Change in financial position of another person. Very interesting. Parent subsidiary. Parent is another person, subsidiary is another person. Any change in the financial position of another person that has resulted, will result, or may reasonably be expected to result from the transaction or arrangement. So, sometimes is suddenly changing the financial position of a subsidiary may result in a change in the financial position of the parent, right? So, it can happen. Some or an appreciation or impairment loss could be booked in the parents' books. So sometimes this corporate tax advantage is not a singular arrangement. Done in it is done together with more than one person. So one example has been quoted. For example, if the 250,000 dirhams that the taxable person had lost had actually been paid to the customer, to a person related to the taxable person, and it is likely that the 250,000 dirham change in the related person's financial position would counter the taxable person's assertion that it had lost the money. But again, I mean, this is a far-fetched example, but still, the tax reviewer or the revenue authorities go out of box to determine such possibilities. Rights or obligations. Whether the transaction or arrangement has created rights or obligations which would not normally be created between persons dealing with each other at arm's length in respect of the relevant transaction or arrangement. So, yeah, I mean, uh, one entity wanted to demonstrate, one UAE entity wanted to demonstrate control on on a Saudi entity where a direct shareholding arrangement is not really present, and they in the UAE balance sheet they created one asset called investment in associate or investment in XYZ company, and on the liability side they created a liability, a loan, which basically, if you really think about it, the asset and liability are contra, there are contra items on the balance sheet, and it was only an arrangement so that the loan may be extended to Saudi Arabia, and thus the corporate tax liability may be reduced. This can also happen, fake rights and obligations being created. I have seen one case here in UAE. Cannot go into details, but this is has also happened. Creation of such fake rights and obligations. The fact that the parties are not dealing at arm's length, for example, transactions between spouse or associated companies would be taken into account. So, various aspects can come into play in this. I just gave you one example. Other relevant information. Any other relevant information and circumstances determining which other information and circumstances may be relevant may be determined from answering some of the questions. And naturally, this is an open-ended area. We cannot, limit it to a few points. Is the arrangement out of step with the ordinary family dealings or the sort of arrangements ordinarily used? So that's where the benchmarking comes in. You have to look at the industry norms or the benchmark. Does the arrangement seem more complex than is necessary to achieve the relevant family or commercial objectives? Complexity of the transactions. If it is too complex, questions will arise. Is there a step or a series of steps involved in arrangement that appear to serve no real purpose other than to gain tax advantage? Yeah, I mean, too many steps are there which may not have been necessary. Does the tax result appear at odds with the commercial or economic result? Naturally, it doesn't make sense that a company of this size, a relatively larger size, would end up paying a very small amount of corporate tax, and especially when the sector is also on the rise, on the boom. Is there little or no risk in circumstances where significant risks would normally be expected? For example, use of non-recourse or limited recourse loans, or maybe unsecured loans, which limit the party's risk or actual detriment in relation to debts or investment. Arrangement where the taxpayer's risk is significantly limited because of the existence, for example, of a put option. So, many examples could be there. These are just a few examples, but the point is that this subject is too vast, and determination of whether a corporate tax advantage has been achieved or not, that will require a very detailed evaluation of the circumstances and conditions. Since there are similarities between Article 50, Clause 5, and the anti-abuse provisions known as Part 4A, incorporated into the Australian Income Tax Assessment 1936. So, Mr. Nawzar, this is your area. Some of the commentary to the Part 4A is likely to be persuasive to the FTA, as would be some of the decisions of the Australian courts on that part. For this reason, commentary in this module under each of the Article 50, Clause 5 paragraphs have incorporated some of the commentary on the similar provisions in the Australian tax law. So what we read just now, quite a lot of points were basically taken from the Australian anti-abuse rules.
Sorry, I just had one question. So, if let's say, and we have discussed this example multiple times, that if a company has, 400,000 of AED of income, so rather than showing one company, they make two companies and they divide the income, would that still be considered as and abuse of law, or would that be not considered as taking as an unfair tax advantage?
Very interesting question. Why? Because if I recall correctly, the very first decision that came after the corporate tax decree law was issued, I think it was in February of 2023. And that was it contained exactly this point, Abbas. If you go back and look at that decision, you will
Okay.
find that it is expressly stated there that artificial splitting will be disregarded by FTA. It will be seen as gaining a corporate tax advantage. But again, that's a very simplistic way of saying it. If I say that, okay, if you split the company, it will be immediately seen as corporate tax advantage. We will have to give due
Mm,
consideration to the economic realities, whether there is a very clear-cut reason for it. It could be that, segmentation, right? One entity is into manufacturing, another entity is into distribution, right? And the company has a clear vision that no, we want to segregate our business into two divisions, and we want both divisions to prosper separately under two different managements. That's a very clear-cut commercial rationale, right? And we cannot completely disregard it, right? Or maybe the two segments were completely unrelated, right? And we wanted to segregate it. One was technology division of a consulting firm, other one was purely advisory. And it is very clear that technology companies would probably prosper better if they had a separate legal entity. So naturally, due consideration has to be given to the ground facts. So it's not a black and white decision. We have to evaluate.
Okay,
Just and
thank
just
you.
and reasonable. In any proceeding concerning the application of Article 50, the FTA must demonstrate that the determination made under Article 50, Clause 3 is just and reasonable. So that's the criteria, just and reasonable. Looking for some guidance from HMRC and the UK courts, it is useful to consider Marcus and Marcus Limited versus HMRC, UK FTT 145, reported in the Tax Journal. Let us have a look at this case that happened in UK. The facts were that the company's business was providing supported living and other support and care services for the adults with autism and or learning difficulty. It bought for 875,000 quids a four-bedroom detached house for use in its business. The property was particularly attractive because of the outbuildings. One of these had previously been used to run a day nursery, but could be used as two additional dwellings separated from the main house, which were ideally suited to the needs of the two particular clients of the company. There were two further outbuildings, an office and summer house or shed, and the question before the tribunal was essentially whether each of those buildings should be lumped in with the main house or with the nursery dwellings when apportioning the 875,000 pounds consideration for MDR purposes. I don't know what MDR stands for, but I mean, let's call it tax purposes. But the wider interest of the case lies not in the question of how the assets should be grouped, but in the tribunal's comments on the basis on which any apportionment should be made. So that will be an interesting discussion. Let's have a look at it. The company HMRC had agreed that the apportionment would be made by reference to the size of the floor areas of the respective buildings. Notwithstanding that agreement, the tribunal nonetheless addressed the question whether that was a just and reasonable basis. So the tribunal basically questioned it. That is the floor area the best basis for apportioning the consideration? What methodology is just and reasonable may vary from case to case and will depend on the facts and circumstances of the case. The tribunal listed the apportionment candidates as including market value, size, value of the appellant on the basis of intended use, and value to a hypothetical purchaser such as a developer. So each of these might reap a different value, apportionment value of the 875,000 consideration. So uh, the tribunal was content to agree the floor area method, despite HMRC's own valuer having commented in an internal note that this was really pushing the envelope in terms of trying to reach an amicable settlement to your case, which is particularly favorable to the taxpayer, mainly because it regarded the nursery as at least as important as the main house, given that the rare configuration of the Annex C made it ideal for users accommodation for two particularly challenging clients. And the other outbuilding was also important in the expanding of the services. From this decision, it is possible to conclude that there is no one size fits all approach to what is just and reasonable when it comes to apportioning. So after reading all of the arguments that we have just read, The earlier point that I was raising still stays intact. We will have to always pay consideration to all the circumstances and different ways of looking at things when we are, for example, apportioning revenue, or, for example, we are about to take a decision whether a corporate tax advantage has been achieved or not. Assessment of corporate tax and penalties. So there's an Article 60 in the corporate tax decree law. A person may be subject to corporate tax assessment in accordance with the tax procedures law and decisions issued in the implementation of its provisions. A person may be subject to corporate tax assessment in accordance with the tax procedures law and the decisions issued for implementing the provisions, and notwithstanding the provisions in the procedures law and the decisions implementing decisions, FTA may prescribe the circumstances and conditions under which a corporate tax assessment may be requested by a taxable person. So this is referring to FTA decision actually, that under what circumstances an assessment would be in order. The tax procedure law referred to in the preamble to the decree law and the decisions issued in the implementation shall determine the relevant penalties and fines. So if you go into the tax procedures law, at the end of it, you will find a detailed schedule of penalties for various types of offenses. Article 60 of the decree law confirms that the issue of a tax assessment and the imposition of penalties and fines is to be in accordance with the procedures written into that law, and there are executive regulations as well. This is an older version because the latest version of the executive regulations is 2023. The article also states that notwithstanding those provisions, the FTA may establish the circumstances and conditions under which FTA may issue an assessment, and those under which the taxpayer may ask for the assessment to be issued. So procedures for assessment, in short, have been laid out and defined under the tax procedures law, and only in line with those procedures. Okay, they have mentioned it. Cabinet Decision number 75 of 2023 on the administrative penalties for violations related to the application of the federal law number 47 uh, has been issued, listing 13 violations and corresponding penalties. Let us probably will it may not be here, but it is available in the tax procedures law. A very famous and debated and contested topic: voluntary disclosures. In this section, you will learn about voluntary disclosures, which is Article 10 of the Tax Procedures Law. Let us have a look at it. When to submit a voluntary disclosure. When to submit a voluntary disclosure. We need, if a taxable person becomes aware that a tax return submitted to the FTA or a tax assessment issued by FTA is incorrect, which resulted in a calculation of payable tax according to the tax law being less than it should have been, meaning more payment to FTA should have been done. But as a result of the assessment, FTA also even gave a wrong assessment, then the taxable person shall submit a voluntary disclosure. Let's have a look at the tax return. The information and data specified for tax purposes and submitted by a taxable person to the FTA for tax purposes in the form and manner as prescribed by FTA, including the relevant attachment and schedules. Let me ask a question here. Somebody wants to avoid tax by delaying the payment. On purpose, they refrain from putting some invoices or output tax on those invoices in their VAT return. Do you think a voluntary disclosure of that fact in the next return will save that person from penalties? Just a common sense question. Let's say that mistake was unintentional even.
I think it should, because I mean depends on the intention. Because if it's unintentional, then they could, because though the cash flow was delayed by a quarter, they still would, the authorities would still will get the actual amount on the tax.
So
But if let's
that
say it was intentional, then maybe it could result in penalties.
that's exactly what happened in the very beginning of the VAT law somewhere in 2018, Abbas. And then later on, FTA realized that this is being misused. So on purpose, people are deferring their output tax. So
Okay.
soon enough, it was changed. And later on, even if by error you have missed out paying of output tax, it was penalized. A relatively
Okay.
small penalty, but it is still subject to penalty. And voluntary disclosure is also a
Yes.
mandatory requirement for that.
Yes, but Australia, we need to amend in that particular quarter, not in the future quarter. If you miss some invoice in like the 2023 the March quarter, then you need to go and amend that March quarter, not the current quarter.
Let us read through if there is this thing available. Let us go through, we'll find out. Tax assessment. The decision issued by FTA in accordance with Article 23 of the Tax Procedures Law. This Article 23 is very important because it lays down the foundation of tax assessments that are performed by FTA, not by the person, but by the FTA. Payable tax. Tax that has become due for payment to FTA. Various definitions they are given. Voluntary disclosure. A form prepared by the FTA pursuant to which a taxpayer notifies the Federal Tax Authority of an error or omission in the tax return. Tax assessment or tax refund application in accordance with the provisions of Article 10 of the Tax Procedures Law of 2022. So, if I recall correctly, the VAT returns that are filed, there is I think, very small window of time whereby you can amend the VAT returns. But naturally, a key point here, Mr. Nauzer, is that whether you amend the VAT return or give a voluntary disclosure or do anything, if the payment has been delayed, right? There are 28 days for VAT returns, right? For example, 31st December, if someone's VAT quarter has finished, they have 28 days in UAE to file the tax VAT return and pay the money, right? And if even by mistake the taxpayer failed to pay the full amount of liability, and later on immediately they amended it, they found out the mistake and amended it, there will still be a fixed penalty that they will need to pay. The compulsory disclosure. First was voluntary disclosure. Now we're coming to compulsory disclosure. Let us have a look at it directly. The taxable person is required to voluntarily disclose to FTA that the tax paid by reference to the taxable income disclosed on his return or the tax on the tax assessment underestimated the corporate tax which would have been paid. The disclosure is compulsory. Underpayment, if taxpayer becomes aware, then it is a compulsory disclosure actually. On 30th September 2025, this is an example. The taxable person's tax manager self-assessed and paid a 350,000 tax liability for the tax period 2024. Okay. Uh, on 15 October 2025, the chief accountant informed the tax manager that the self-assessment should have been 500,000, not 350,000. 150 short payment. Tax manager must voluntarily disclose this under the assessment to the FTA. The words written here are must voluntarily disclose. But what does this must mean? It's a compulsory disclosure. And this is most important in case of underpayment of tax. Overpayment of tax, FTA will not mind. More money is coming to them. Later on, they can give back the advantage. They can even refund it. But underpayment, that is a very sensitive area. If a taxpayer becomes aware that a tax refund application submitted to the FTA is incorrect, which resulted in the calculation of a refund amount to which he is entitled according to the tax law, uh, being more than it should have been, the taxpayer shall submit a voluntary disclosure. So, for a tax refund, I paid more than what was required. Can you please refund my money? The taxable person is required to voluntarily disclose to the FTA that the tax refund received exceeded the amount which the taxable person should have received. So that is also another case. So the money of FTA, money of the government treasury, that is a, whether it is underpayment or underpayment made by the taxpayer or overpayment received by the taxpayer. In both cases, disclosure will be compulsory. On 30th September 2026, the taxable person's tax manager self-assessed an 84,50,000 tax refund for the 2025 tax period. On 29th October 26, the chief accountant informed the tax manager that the self-assessment refund should have been only 390,000. The tax manager must voluntarily disclose to the FTA this overpaid refund. If they don't, there's serious penalty. Non-compulsory disclosures, the taxable person becomes aware that a tax return submitted to the FTA or a tax assessment issued by the FTA is incorrect, which resulted in the calculation of payable tax according to the tax law being more than it should have been. So the poor taxpayer had to pay more tax. The taxable person may submit a voluntary disclosure. So that's not compulsory. The taxable person may voluntarily disclose to the FTA that the tax return filed with the FTA was incorrect or the payable tax exceeded the amount which should have been payable. So this is not a compulsory disclosure. On 30th September 25, taxable person's tax manager self-assessed and paid a 350,000 dirhams tax liability for the tax period 24. On 15 October, the chief accountant informed the tax manager that the self-assessment should have been only 290K. So 60,000 was extra paid. Tax manager may voluntarily disclose this over assessment to the FTA, but disclosure is not compulsory. If a taxpayer becomes aware that a tax refund application submit, this is repetition. This is repetition. So I'm going to go. On 30th September.
Excuse me, a small question.
Yes, please.
What is the difference between the voluntary disclosure and the compulsory disclosure? The FTA is handling, the way of FTA handling, they will handle in a both way, or they will give a different approach to the disclosures.
So if FTA is at a disadvantage,
Okay.
that's compulsory disclosure.
Yeah. Yes, I know, but how they react to, they
Exactly.
will quickly respond, or they will respond differently for the.
Yeah, yes, there is different reaction. Common sense would, dictate that whenever FTA is at a disadvantage and the taxpayer has not made that disclosure, there will be penalties.
Okay.
But if the taxpayer is at a disadvantage, poor guy paid more or got less refund than he should have, then that will be a voluntary disclosure. There's no penalties or anything.
Yes, how their response? We think how long they will refund the money, or the time frame for both the scenarios same or different?
Although the procedures for that have been provided in the tax procedures law, there is a specified time period. We will have to resort to the tax procedures law to find out the precise time period. Within that time period, FTA must come back to the taxpayer and give a judgment whether they have accepted or not. If usually from a ground reality, I'm telling you, if the taxpayer has never committed a mistake, if the operations are clean, like it's a reputed company, etc., there have been instances when the refund immediately comes, right? But sometimes whenever FTA has a doubt, the information provided is inaccurate or presented in an unprofessional manner, and FTA has a doubt that there may be we might need more information, they may ask for more information. Okay, so once you provide that information, they will review that information. Once they're convinced that okay, this seems to be a fair claim for corporate tax refund, then they will approve the refund. And you still have a choice. You can you can claim for the refund, in which case the FTA will actually refund the money into your bank account or the taxpayer's bank account, or you can keep that refund as a tax credit in your account. So later returns will be adjusted against that credit. Does that answer your question?
Yes, yes.
Okay. So one example, on 30th September 2026, the taxable person's tax manager self-assessed a 450,000 dirhams tax refund for the 2025 tax period. On 29 October 2026, a few days later, the chief accountant informed the tax manager that the self-assessed refund should have been 85,50,000. So that means the taxable person got less money than he deserved. The tax manager may voluntarily disclose to the FTA this over-calculated refund, but disclosure is not compulsory because this is taxpayers' money. Error in a tax.
Sorry,
Yes.
just so if in the previous example, if you do not disclose to the FD, how would they know that they have to pay a higher or refund?
Yes, you are right. If you don't disclose, the FTA will never know. So, in other words, if you want to claim, you have to disclose.
We have to disclose them, right? Yeah.
Yes. So, error in tax return. If the taxpayer discovers an error or omission in the tax return submitted to the Federal Tax Authority, where there is no difference in the amount of due tax, tax that is calculated and imposed under the provisions of the tax law. Very important point, guys. The taxpayer must correct such return by submitting a voluntary disclosure. So, the tax that was paid, interestingly, would not change, right? For example, there was uh, exempt take the I how do I say that classification. Let's say the classification of one income, you gave one classification, but that income was should have been disclosed under a different class. Okay, but the overall tax position is not changing. That will only require a voluntary disclosure. It will not be penalized. Taxable person must make a voluntary disclosure when discovering an error or omission in the tax return, even if there is no difference in the due tax. That's a key point for us to remember. That disclosure is compulsory one, even if there is no difference in the due tax. This would cover situations such as a loss had been incurred, loss incurred in a previous year had been claimed in the current year, or a foreign tax credit exceeded the UAE corporate tax due by the taxable person. Let's read the example actually. That best explains. The tax manager files a return for 2025 tax period on 30th September 2026, disclosing an AED zero taxable income after claiming a deduction of 250,000 dirhams of the loss incurred in the 2024 tax period to reduce a 250,000 income. The actual loss carried forward was 500,000. On 25th October 26, it is brought to the tax manager's attention that the actual loss was not 500,000 but 475,000 rather than 500,000. While the taxable person's taxable income does not change because their entire income was only 250,000. Even if you change the tax laws from 500,000 to 475,000, you still have adequate buffer to offset the taxable income, right? So that zero tax position, AED zero, does not change. So what happens? While the taxable person's taxable income does not change, tax manager must voluntarily notify the FTA of the error made in the return. Cabinet decision number 74 of 2022 on the executive regulations of this tax procedures law set out the detailed provisions related to submitting a voluntary disclosure to the FTA. Further, there is cabinet decision number 75 on the administrative penalties, and it prescribes the amount of administrative penalties related to voluntary disclosures.
Just one small question. So in the previous example, if the revenue were to be, let's say, 400,000, would you would still need to do the voluntary disclosure, because though the revenue is
Yes,
still below the tax, they still have to do
absolutely.
the disclosure.
Absolutely.
So basically, you have to do a disclosure every time, unless the the result is benefiting the taxpayer. Can I
Yes,
say that?
absolutely, yes. But in this particular case, if you really think about it, uh, the immediate money impact is not there, right?
Yeah. It's not.
Uh,
Yeah.
but still, the voluntary disclosure must be made, right? If
Yeah.
you really think
Yeah.
about it, neither the FTA nor the taxpayer is immediately being affected, right? But still, to keep the record straight, because it may affect future tax periods,
Yes. Yes.
right? So that is why it is important to make that voluntary disclosure.
Okay.
Basically, that whatever mistakes you are doing in the figures, either it's like a taxable or no, you need to amend it.
Yes, you need to amend it.
Amend.
Naturally, more amendment, yes. Amendment, to definitely yes. I mean, because otherwise,
Amendment mean voluntary disclosure. Voluntary
yes, yes,
disclosure.
yes. Once you amend something in your P&L or financial statement, you have to let FTA know if whether it is affecting your corporate tax liability or not. But if it is affecting your corporate tax liability when the FTA is at a disadvantage, it becomes more serious,
Is
right? Yeah.
is there any time limit to to do the voluntary disclosure? You need to do it within 2 years of
I think yes.
end of the financial year or something like that.
If I recall correctly, it is that the moment taxpayer becomes aware of
See,
the
after 5 years, he will come to know about the mistake. Then is still the disclosure will be acceptable or no?
Okay, so that's an area we need to look at because the statute of limitations is
Yes.
5 years.
No, no.
Statute.
I mean at 2 3 years.
Yes, that's
In
what I'm
five
trying.
years, yes.
Yeah, that's what I'm trying to explain to you. If if the taxpayer becomes aware of a return that was filed 2 years ago also, right?
Okay.
And it is very clear that in that year, the payment made to FTA was less than what should have been made. FTA is at a disadvantage. There is no
Yes.
way FTA is going to let go of that. And
Yes.
the person, taxable person, if he does not inform FTA, that's a straightforward offense. So that
Okay.
voluntary disclosure is a must.
Yes, but it will attract the penalty and interest even though he's doing the voluntary disclosure.
Yeah, it will attract the penalty. Whether it will attract the interest or not, that we can. I don't remember it immediately, but we have to
Okay.
look at the schedule of penalties, whether it will attract interest or not. There are high chances it will attract interest as well. Time value.
Okay. Interest and penalties, huh?
Yes, interest and penalties and interest on penalties as well.
Okay.
Voluntary disclosure, time limits. I think some of your questions will be answered here because we are looking at time limits now. Voluntary disclosure, time limit is found in Article 10 of the Cabinet Decision number 74 of 2023. You guys remembered that 20-day rule? We are going to look at 20-day rule. 20 days is a very key figure for us to remember. Let's look at the 10,000 dirham threshold. If a taxable person becomes aware that a tax return submitted by him to FTA or a tax assessment sent to him from the FTA are incorrect, resulting in a calculation of the payable tax according to the tax law being less than required by more than 10,000 dirham, the taxable person shall make a voluntary disclosure to the FTA within 20 business days from the date when the taxable person becomes aware of the error. The 10,000 dirham is a key figure. When you know that the amount of tax that is at stake here is, more than 10,000 dirhams, then the voluntary disclosure becomes compulsory. The voluntary disclosure for underpayment of tax due to filing an incorrect return by more than 10,000 is 20 business days from becoming aware of the error. For example, the tax manager became aware on 15 December 2025 that the tax paid for 2024 tax period was 17,500 less than it should have been paid. Tax managers are required to voluntarily disclose the error to the FTA no later than 20 business days from 15 December 2025. The key point is the day that you become aware. 20 days from the day that you become aware. Immediately you have to make a disclosure, voluntary disclosure. Actually, the name is voluntary disclosure, but it becomes a compulsory disclosure. Not more than 10,000 dirhams. What if the amount is of the underpaid tax is less than 10K? If a taxable person becomes aware that a tax return submitted by him to the FTA or a tax assessment sent to him from the FTA is incorrect, resulting in a calculation of payable tax according to the tax law being less than required by not more than 10,000 dirham, taxable person shall make the following. If the taxable person is obligated to submit a tax return to the authority, correct the error in the tax return that has not become due for submission for a previous tax period. So basically, in the next tax return, you can uh, adjust it. You can include it in the next tax return or in the tax return for the period in which the error has become discovered, whichever is earlier. So, you can make the adjustment in the next tax return because you have a 20 days margin of becoming due, or if it pertains to a previous tax return, then you have to amend the previous tax return. Submit a voluntary disclosure to the authority within 20 business days from the date of becoming aware of the error. In the event that there is no tax return through which the error can be corrected according to subparagraph of this paragraph. So 20 days time limit stays. The day you become aware of a mistake in the calculation of tax, underpayment of tax to FTA, you within 20 days you have to inform FTA. More than the correct amount. If a taxpayer becomes aware that a tax refund application that he has submitted to the FTA is incorrect, resulting in a calculation of a refund to which he is entitled according to the tax law being more than the correct amount. Taxpayer shall make a voluntary disclosure to FTA within 20 business days from the date when the taxpayer becomes aware of the error, unless the error was a result of an incorrect tax return or tax assessment under which Article 10 will apply. So again, in case how do you file a refund? So basically, it's a return. In that return, you have written everything, and at the bottom of the return, there was a refund amount, right? So you submitted that return. So that becomes a that was the filing of the return. But then there is another form that is appearing on the FTA website, which is for tax refunds. You have to fill that form, and you have to submit that form to claim that tax refund or ask for returning the extra money, the refundable money to the bank account of the taxpayer. So the moment you become aware that we did a mistake, we claimed more tax refund than it would have become due. So immediately becoming, 20 days, up to 20 days after becoming aware, you have to inform FTA that this was a mistake. Our refund is not the amount that we have claimed. The voluntary disclosure to be made to FTA within 20 business days from becoming aware of the error uh, in the tax refund calculation. If the error arose from an incorrect tax return or tax assessment, then the timeline in Article 10 will apply. For example, let's read this example. The tax manager became aware on 15 December 2025 that the tax refund for the 2024 tax period was 50,000 more than it should have been. tax managers are required to voluntarily disclose the error to the FTA no later than 20 business days from this day when he actually became aware of the error. This we read already, but anyways, let's repeat. If a taxpayer becomes aware of an error or omission in the tax return submitted to the authority without there being a difference in due tax, so the tax liability did not change, it still remains the same. Taxpayer shall correct the error or submit a voluntary disclosure to the authority as may be specified by the authority. For the purposes of implementing Article 10, a voluntary disclosure must be made in accordance with the form directed by the FTA. Methods of notification. This is Article 11 of the Tax Procedures Law of 2022. First thing, FTA shall notify to the person of any decisions or procedures through the address registered with the FTA, registered address. That's one way of notification. Deemed as notified. A person shall be deemed as having been notified of any decision and as having received any correspondence if the FTA has sent the notification correspondence in accordance with Article 11 of the Tax Procedures Law. So Article 11 is on notifications. If one of the methods specified there has been adopted by FTA, then the person will be deemed to have been notified. The executive regulations shall specify the means used for notification and correspondence. Notification of the decisions or procedures issued by the FTA will be sent to the taxable person's registered address. So, and will be deemed to have been received by the taxable person if issued in accordance with Article 11 of the decision, which is executive regulations for the procedures, tax procedures law. Those of you who are studying this, I sincerely suggest that you should go to Federal Tax Authority's website and download the tax procedures law as well as the executive regulations. You can find it on the Ministry of Finance website as well. Means of notification and Article 11 of the Cabinet decision on the executive regulations for the tax procedures. FTA shall notify the person, its tax agent or legal representative as applicable at the address registered with the FTA by any of the following means: post, registered post, email, mobile text message, smart applications, or the electronic system of the authority. Posting a prominent place, posting in a prominent place in the premises of the person. You can have the notice stick on your office or factory as well, door as well. Any other means as may be agreed in writing by the person and the authority. For the purpose of this article, the address registered with the authority includes but not limited to the address provided by the person to the authority or the address of its usual or last known place of residence or business. So these will be considered as the registered address. By FTA issuing the notification by post, it is treated as having been received by the taxable person. That's a very interesting angle. If the FTA considers that notifying the unregistered person by the means mentioned in clause 1 of this article is not practical for the case of notification mentioned in another article 13 of the decision, notification may be made by posting a notice in a printed or written form at the premises at which the tax audit is to be conducted. Place of business, basically. The FTA can paste a notice on the place of business. Tax audits, key point. In this section, you will, yeah.
The previous register, unregistered person is what?
Unregistered person.
Yes.
I
In previous, yes. Previous.
Unregistered person.
Unregistered, something called unregistered. I think.
No, there is nothing unregistered here. It's all registered address, and FTA does not deal with unregistered address.
I saw somewhere unregistered.
Okay. This is the entire page. There's nothing written as unregistered everywhere. It is, it is written as registered.
Okay.
This one, FTA considers that notifying the unregistered person
Unregistered person
by the
the
means mentioned in clause 1 of this article is not practical.
What do you mean by unregistered person? Mean he's not registered with the FTA or what?
Consider that notifying the unregistered person by the means mentioned of this article is not practical for the cases of notification. I think probably they mean that the responsible persons, for example, the shareholder, let's say, right? That is not a registered person, not a registered taxable person or a registered person with FTA. Individuals are not, right? So unless that individual is doing a business in his capacity as sole proprietor, here those responsible persons who are individuals, for them, I think this is being addressed. If FTA considers that notifying the unregistered persons by means mentioned in the clause 1 of this article is not practical for the cases of notification mentioned in Article 13 of the decision, that notification may be posted in print or other form on the premises. How would you send notification to an individual? Through a post mail, right?
Post,
Or
yes, post,
email
yes.
or mobile text. But
Yes.
FTA feels that, okay, fine, we will adopt these methods to send the information to the shareholders, for example, but they will not respond, right? FTA has to complete its procedures before enforcement action is taken, right? So what they will do, they will conclude that, okay, it will not work to send shareholders the email or post mail or mobile text. Let's do another thing. Let's print that notice and paste it on the premises of the office or factory, right? Why? Because then that taxable person will be deemed to have been duly notified. And even if after notification they don't fulfill their obligations, then FTA has clear grounds to take enforcement action. Clear? Tax audits. A tax audit is a procedure undertaken by the FTA to inspect the commercial record, information, data, or goods related to the person to determine whether the person has fulfilled his obligation under the Tax Procedures Law 2022 or the tax law. Let's have a look at tax audit procedures. FTA may audit any person to verify that person's compliance with the decree law, compliance with the Tax Procedures Law, basically. FTA shall notify the person of a tax audit at least 10 business days prior to conducting the tax audit. Business days are any days of the week except weekends and official holidays of the federal government. FTA may perform the tax audit at its premises or the place of business of the person subject to the tax audit or any other place where such person conducts business, stores goods, or keeps records. So the FTA has quite wide authorities in this regard. By way of exception to Article 16, the tax auditor, any employee of the FTA appointed to conduct a tax audit, may enter without prior notification any place where the person subject to the tax audit conducts his business, stores goods, or keeps records, and may temporarily close that place in order to perform the tax audit for a period not exceeding 72, I think this is hours, in any of the following cases. If the FTA has serious grounds to believe that the person subject to the tax audit is participating or involved in tax evasion, which is crime, in respect of any of his or any other person's obligations imposed under the tax procedures law. If it is tax evasion, then extreme measures like closure of the facilities can be taken. In respect of any of his or any other person's obligations imposed under the tax procedures law or the tax law, if the FTA has serious grounds to believe that not temporarily closing the place where the tax audit is conducted will hinder the conduct of the tax audit. Then FTA can even close the business just for the sake of conducting tax audit. If the person who has been given advance notice of the tax audit attempts to stop the tax auditor from entering the place where the tax audit is to be performed. Tax evasion is the person's use of illegal means resulting in reduction of the amount of the due tax, non-payment thereof, or a refund of tax that a person did not have the right to have refunded under the tax law. So illegal ways of basically gaining a tax advantage. In conclusion, if the auditor concludes the taxable person was engaged in tax evasion and believes that not closing the premises will hinder the auditor, or having been given the required notice, the person attempts to prevent the auditor conducting the audit, the auditor can enter the person's premises and may temporarily close it for 72 hours to allow the audit to be conducted. So 72 hours, 3 days. In all cases stipulated in Article 16 of this tax procedures law, the tax auditor must obtain prior written consent of the FTA DG, General Khalid Al-Bustani, at the date of the writing, or the person acting on his behalf. And if the place to be accessed is a place of residence, then a permit from the public prosecution must also be obtained. So basically, the DG will directly authorize the person to conduct the tax audit. And you know, if the place is to be accessed is a place of residence, then the public prosecution office permission also needs to be obtained. Public prosecution is part of Abu Dhabi Judicial Authority, whose role is to initiate and take actions on criminal cases on behalf of the society members, either by referral to the court or by an issuing of a decision of dismissal. So this is a government authority basically which enforces law. Place closed under Article 16 shall be reopened upon the expiration of 72 hours unless the FTA obtains a permit from the public prosecution to extend the closure period for a similar period prior to the expiry of the period mentioned in Article 16. So within 72 hours, FTA must obtain permit from public prosecution office to extend the closure beyond 72 hours. The executive regulation shall determine the necessary procedures related to tax audit, and these follow in the section below. We are going to have a look at these procedures, executive regulations. Regularity of tax audits, which is Article 11, conducting the tax audit, which is Article 15 of the Cabinet decision on executive regulations. Let us have a look at it. When the FTA decides on whether or not to conduct a tax audit on a person, it shall consider the following: that a tax audit is necessary for protecting the integrity of the tax system. Somebody was cheating the tax system, a taxpayer, then it becomes necessary to conduct the tax audit. The responsibility of the person or anyone associated with him to comply with the law and the tax law. So these are the considerations that the FTA will have. Responsibility of the person, the likely tax revenue at stake, like if it is only for maybe 1,000 dirhams, maybe the tax audit will not be conducted. But if it is 1,000,000 dirhams of revenue, absolutely yes. The how much amount, the significance of the tax revenue at stake, and the administrative and compliance burdens on both the person and the FTA resulting from performing of a tax audit. Naturally, it is a burdensome job. Resources have to be mobilized. The administrative and compliance burdens on both the person and the FTA resulting from the performance of the audit. So like how much amount of effort and to what end? Is it like significant? Or if it is peanuts, then probably they'll say, okay, let's do a review and be done with it. In conclusion, one of the three reasons of the FTA may commence an audit is the amount of due tax payable, taking into account the compliance and administrative obligations. Re-auditing. If the FTA decides to re-audit a business, it shall take into consideration the results of the previous tax audit, any new information or data which are likely to change the FTA's position. Without reference to the previous audit, it may become re-auditing may become questionable. Challenging the audit. The FTA's right to conduct an audit is not capable of being challenged by any person. FTA's right is, non-contestable. For example, a taxable person's tax manager objected to the tax auditor's proposal to commence an audit on the grounds that the tax manager was involved in a 2-week company-wide planning meeting in New York, followed by a month's honeymoon in Los Angeles. Auditor refused to defer commencing the audit and was entitled to take that position. So you can't defer for any business reasons. Notice of audit, Article 16 tax procedures. So Article 16 sets out the form of notice to be given. Let's have a look at it. Any notice of a tax audit sent by FTA shall state the possible consequences of obstructing the tax auditor in the exercise of his duty. Notice of delivery. Where a tax auditor is assigned to carry out a tax audit according to Article 16 of the Procedures Law, he shall provide a notice in writing at the beginning of the tax audit to the following. The occupying tenant of the premises, if he is present at the time of beginning the tax audit. So it is a responsibility of the tax auditor to inform people. The person who appears to be in charge of the premises, if he is present and occupying tenant is not present. So the in charge person who appears to be in charge, that person has to be advised that the tax audit is starting. In any other case, the notice shall be posted on a prominent place in the premises. Otherwise, you can paste as well. The tax auditor can paste the notice of audit. Now, we'll be talking about the conduct of audit, tax audit procedures, which is Article 17 of the Executive Regulations on Tax Procedures Law. For the purpose of conducting a tax audit, FTA may inspect the following: premises, documents available at the premises, assets that are available at the premises. Assets refer to tangible assets, including equipment, machinery, stock, others that the authority has considered as owned, leased, or used in connection with the conduct of the of business by any person. Accounting system used by the person subject to audit. So, even in today's world, digital data, naturally, it will be there on the machines. That will also become even more relevant. The tax auditor is given very wide inspection powers. The items the auditor can inspect under Article 17 provides strong indication of the facilities, records, documents, and procedures which the taxable person should have available for inspection. So, literally everything the tax auditor can access. The tax auditor requested the tax manager to provide the company's allocation of costs between different depreciable categories on a 35-story building, office building in Dera. The tax auditor wanted to validate the depreciation rates had been applied to the correct expenditure amounts. The tax manager refused to provide the cost allocations, and in refusing is in breach of Article 17. Recently, during the past month, actually, I have been part of a major engagement which involves, the court procedures, and there was some, some, how do you say, cleverness shown by the management without naming the client or anything. I'm just sharing with you. And I was the kind of appointed designated auditor there. And I became a little bit upset that stop playing games with me. Answer my questions. Unless you do the answering, I will continue to ask you back. And this is going to go forever. And by the looks of me only, the client was, like They were so much afraid that immediately and instantly, whatever I was asking, it became available. So the tax auditor, or for that matter, other regulatory auditors, have been given very wide powers, and lack of cooperation with them is a very serious matter here in UAE. Example: the tax auditor requested the tax manager to provide the.
So,
Oh,
so
yes.
yeah, sorry. So, are you saying that the government can sort of employ private tax auditors as well for the purpose,
I
or
am not
am I
saying that.
misunderstanding?
No, I'm not saying that. And actually, I was not a tax auditor in the example that I quoted.
Okay, okay, okay. Sorry. Okay,
I was something else,
okay. All right.
but I was still an auditor.
Okay.
Anyways, coping, timing, new information, and cooperation. But what I was telling you, Abbas, was that the capacity that the tax auditor gets is very similar to
Yeah.
what I had. So,
Yeah. Yeah.
legally enforceable capacity, and it becomes very, it's a sensitive thing for the person at the receiving end.
Yeah.
Copies, timing, new information, and cooperation. Article 17 to 20, Tax Procedures Law, contain information about the FTA's right to obtain copies during the tax audit, timing of the tax audit, new information surfacing after the tax audit, and cooperation during the tax audit. So let us have a look at Article 17 to 20. The right of the FTA to obtain the original records or copies during the tax audit, which is Article 17 of the Tax Procedures Law. While conducting the tax audit, the tax auditor may obtain original records or copies thereof and take samples of the goods, devices, or other assets from the place at which the person subject to the tax audit conducts his business, or which are in his possession. So basically, all records, all information that is needed for conducting the tax audit. Timing of the tax audit, Article 18 of the Tax Procedures Law. The tax audit shall be conducted during the official working hours of the FTA. In case of necessity, a tax audit may be exceptionally conducted outside such hours by a decision of the Director General or by the person acting on his behalf. So, late sittings are quite possible in this.
Sorry, I have a small question.
Yes, please.
Will they conduct the tax audit in a auditor's office, or always in the client place?
This you read in a previous slide. Can somebody else answer this question? Anybody who would like to answer this question? It can happen in both places, sir. The tax audit can happen in depending on the discretion of the tax auditor. It can happen in FTA premises also, in their own office space, and it can happen in the business premises of the taxpayer as well. Okay.
Auditor's place also, audit office say that your office.
Yeah, it can happen
Can
in.
they visit your office also?
Yeah. See, this is ground. This is all. How do you say, ground realities or ground situations? But that the where the audit takes place has secondary importance. Primary importance is the objective of the audit should be achieved. So it is discretion of the tax auditor where he deems it fit. Okay. It can happen any place. It can happen in a, but see, as far as the law goes, it says it can happen in FTA office and it can happen in the client premises. So we are going to stick to this, although the ground realities may change. See, the private sector to date has not yet been involved for corporate tax. I'm not aware if for VAT still tax audits have started, but it remains to be seen whether it will happen. But let me tell you something. The ground reality, I'm telling you that even if such audits are outsourced to chartered accountants firms, or other firms, there is a very high likelihood that quite a lot of work will be done in the premises of those firms itself. Okay. New information surfacing after the tax audit. Without prejudice to the provision of Article 46 of the Tax Procedures Decree Law, FTA may audit any matter previously audited if new information surfaces that might impact the outcome of the audit, provided that the tax audit procedures shall apply in accordance with the provision of the tax procedures law in the executive regulation. So naturally, I mean, it is a responsibility on part of FTA as well, or as soon as new information comes into picture, that makes FTA to believe that the previous audit findings or conclusions require a revisit or even modification, then re-auditing can happen. An auditor is not prevented from opening an apparently closed audit should new and relevant information become available. For example, the audit of the 2024 tax period was closed on 15 April 2026. On 30th September 2026, additional information was voluntarily disclosed by the tax manager to the FTA. The information was that 100,000 dirhams worth of revenue, which was shown as a liability in 2024 balance sheet, should have been included in 24 trading profits. The tax auditor can reopen the 2024 audit. New information, key information. Cooperation during the tax audit. A person subject to tax audit, his tax agent or legal representative shall facilitate and provide assistance to the tax auditor to enable him to perform his duties. So naturally, as I mentioned earlier, for example, the auditor visits the company's premises in July 26 to audit the tax returns of the taxable person's 2024 tax period, and the tax manager does not provide the auditor with the relevant records, this will be a breach of Article 20 of the Tax Procedures Law. The right of persons subject to tax audits, Article 21 of the Tax Procedures Law. The person subject to tax audit has the right to, number one, request the tax auditor to show his job identification card. Very, very, very important. Obtain a copy of the notification of the tax audit, attend the tax audit which takes place outside the Federal Tax Authority, obtain copies of any original paper or digital documents seized or obtained by the Federal Tax Authority during the tax audit in accordance with the executive regulation. Rights of the person being audited during the audit process are administrative. The person being audited has no right to debate technical tax issues with the tax auditor. Ground reality, when the audit is happening, there can be a dialogue. It has happened. I have been part of that dialogue with the tax officers, and explaining to them, or even sometimes uh, you know arguing on that to clarify. And the Federal Tax Authority personnel are quite open-minded. FTA is not like those very bureaucratic, how do you say, a bad organization. It's a very progressive organization, and people listen to what you have to say. Yeah. The FTA auditor arrives at the taxable person's premises and on request to produce her job identification card is unable to do so. Audit ceases until the auditor returns next day with the card. It is a right of the taxpayer, of the taxable person, to ask the auditor to show identification. Legal right. Tax audit results. In this section, you will learn about tax audit results and notification of the results. Let's first look at the notification of the tax audit results, Article 22 of the Tax Procedures Law. The FTA shall inform the person subject to tax audit of the result of the tax audit within the time frame and according to the procedures specified in the executive regulations, which are set out in Article 19 of the executive regulations. So basically, information of the results of the tax audit they have to be shared with the taxable person. The person subject to tax audit may view or obtain the documents and data on which the authority based its assessment of due tax and administrative penalties according to the provisions specified in the executive regulations. Guys, paper-based things that we read in this course, or for that matter in the laws, etc., uh, in the end they will hold. But I'm telling you a practical view of things, that in reality things go slightly differently from what is written here. On a broad level, it happens, notifications happen, all the rights are exercised, etc. But at field level, there is a lot of dialogue between the tax auditor and the taxpayer. Results of the tax audit, let's have a look at it. The person subject to tax audit shall be notified of the results of the tax audit within 10 business days from the end of the audit. Key information for us to remember: 10 business days. Where the person subject to tax audit is notified of the results of the tax audit, he may request the FTA to view or obtain documents, which are original documents or copies thereof, that are related to the person conducting the business and forming a part of the person's legal records, and data on which the FTA based the assessment of due tax. So what were we looking at? Results of the tax audit. Yes. Person is notified, and he can also request FTA, can you please share how did you calculate my tax liability? So the FTA is bound to share that. The taxable person being audited has a right to request the documents and data from FTA which were used as the basis of the assessment issued. So FTA will require, provide all that information to the taxable person to put their mind at ease that it's not a baseless calculation. We have done our share of the working. The taxable person is required to request the documents in writing or another approved format within 20 business days of being notified of the audit decision, and the FTA is required to provide the documents within 10 business days of receiving the request. So the taxable person has how many days? 20 days to go back to FTA asking for information or saying anything, and FTA must provide that information within 10 days. The request shall be made in writing through such other form adopted by the FTA within 20 business days from the date of the notice provided by the FTA, and shall provide the requested information within 10 business days in the following manner: a paper or electronic copy. I think we all know what is the dominant method nowadays. It is electronic copy. Hardly paper correspondence is happening. Or electronic copy of the document or data requested, the original document or data requested, if such documents or data belongs to the person subject to the tax audit who made the request. So original documents can also be requested and they will be provided. Internal information. Documents or data which would reveal internal correspondence or decisions made by the FTA. So basically, FTA is not required to provide the following three types of information: internal information, confidential information, and requested information. Let us have a look at it. Internal, FTA cannot reveal its own internal procedures. Some of them are confidential. Second category is confidential information. Any confidential information or data related to any other person or person. Like the taxable person says, why have you passed this adjustment? It affects that other, buyer as well. We sold it to them. So can you provide us their financial statements? FTA is going to deny that because it may be confidential information and they may not have the authority to share that. Third category, requested information. Any document or data which are known to be in possession of the person who is subject to tax audit and made the request. In this case, FTA shall provide the person subject to tax audit with sufficient information to enable them to identify the document and data requested. Right, this is your record. You are asking us to provide your own record. So that's and it has happened, by the way. Let me tell you, I have personally, experienced it. Tax and administrative penalty assessments. In this section, you will learn about tax and administrative penalty assessment. You will start with the tax assessment, which is Article 23 of the Tax Procedures Law. FTA shall issue a tax assessment to determine the value of payable tax, refundable tax, or any other matters as prescribed by the tax law or executive regulations, and shall notify the taxpayer within 10 business days of the issuance. So let us have a look at all the three. Tax assessment, a decision issued by the FTA in relation to payable tax or refundable tax. Usually, even if it is a digital copy, this tax assessment order is signed by the Director General himself, General Khalid Al-Bustani. Payable tax, the tax that has become due for payment to the FTA. And the third one is refundable tax, the amounts that have been paid and the FTA may return in whole or in part to the taxpayer pursuant to the relevant tax law required to use for the payment. I think we've read these things quite a few times. Tax assessment can be issued in any of the following cases. Some cases have been mentioned here. Let's go through. Taxable person failing to apply for registration. So basically, it's a unilateral action taken by FTA. The taxable person failing to apply for registration within the time frame specified by the tax law. The failure to register can trigger an assessment. Registrant failing to submit a tax return within the time frame specified by the tax law. The failure to file on time can trigger a penalty. The registrant failing to pay the tax stated as payable tax on the tax return. Return was filed, payment was not made. That was submitted within the period specified by the tax law, again a penalty. Taxable person submitted incorrect tax return, registrant failing to calculate tax on behalf of another person when he's obligated to do so, like that, withholding tax, with or there being a shortfall in payable tax as a result of a person evading tax, or as a result of tax evasion in which the person was involved, or any other cases. All of these cases are going to trigger penalties, and you can find those penalties automatically displayed in the Imara tax portal, where you use a login for yourself or your client. If any penalty is applied, you will find that. As a matter of fact, even the tax assessment, unilateral tax assessment that is done, that also you will find in the correspondence menu of the Imara tax, but it will also come to the registered email address of the taxpayer. If it is not possible to determine the actual amount of due tax that is calculated and imposed under the provisions of the tax law, or correctness of the tax return, FTA may issue an estimated tax assessment to assess the payable tax and the refundable tax, in which case FTA shall amend and notify. What is the amend? Amend the estimated tax assessment issued pursuant to this article where new relevant information surfaces which affects the tax assessment. So first step, issue an estimated tax assessment. But later on, FTA finds that there is more, articulate information available, so they will amend the original assessment order. Notify. Notify the concerned person of such amendments within 10 business days from the date of the amendment. FTA is supposed to notify within 10 business days. So if you really look at it, the time duration that has been afforded to FTA under the law is less than the time duration that has been afforded to the taxpayer, 20 business days. Taxpayer can go back to FTA within 20 business days if they find something wrong in the assessment of the FTA, or they find out an error. Everything, 20 business days are available to the taxpayer. But what about FTA? Once the taxpayer goes to FTA, then the time starts clicking with FTA, and the maximum time is 10 days. FTA has to return back within 10 days with the information, with amendment, anything. Executive regulations shall specify the information or data that must be included in the tax assessment. So, in summary, FTA may issue an estimated tax assessment in the circumstances in which relevant information to issue the assessment is not available. When that information becomes available, an amended assessment is issued, and the taxable person is to be notified within 10 business days of the date of the amendment. More administrative penalties. Article 21 of the Cabinet Decision number 74 on executive regulations of the tax procedures law. FTA shall issue an administrative penalties assessment for the person and notify him of the administrative penalties assessment within 5 business days for any of the violation. Here, the window is even smaller. For administrative penalties assessment, the window is only 5 days. Window for FTA is only 5 days. In order to avoid the situations giving rise to these penalties, the taxable person must establish robust compliance procedures. Naturally, the executive regulations shall specify the information and data that must be included in the administrative penalties assessment. This is covered in Article 21 of the regulations. So, what kind of data and information must be included while making an assessment of the administrative penalties that has been provided in executive regulation? Generally, it is common sense data, the historic information, invoices, bills, email correspondence, all of that. Cabinet shall issue a decision that specifies the administrative penalties for each of the violations listed in Article 24 of the Tax Procedures Law. And there is a cabinet decision on administrative penalties as well for violations related to the application of the tax law. These are the references to the laws basically. So there is one thing called tax procedures law. Then there is executive regulations on that of that tax procedures law. And then there is one more law, the law of penalties. So that law of penalties is actually cabinet decision number 75 on the administrative penalties. The amount of any administrative penalty shall not exceed 2 times the amount of tax in respect of which administrative penalty assessment was issued. So your penalty can maximum be 200% of the original tax that was avoided or evaded. List of violations, let's have a look at it. So various violations. Failure of the person conducting a business or business activity or having a tax obligation under the tax procedures law or the corporate tax law to keep required records. Mr. Nozer, this is for you, especially because you will be starting the practice here if you have not already. But failure to maintain records, the penalty is there, and other information specified in the law. One of the following penalties shall apply: 10,000 for each violation and 20,000 in case of repeated violation within 24 months from the date of the last violation. Failure of the person conducting business activity or having tax obligation under the tax procedures law to submit the data, records, and documents related to tax in Arabic to the authority when requested. You can understand the importance of communicating in Arabic, but that happens only when the FTA comes back to you saying provide us the translation in Arabic. If they don't ask you, then it does not apply. The penalty is 5,000 dirham.
But then even in that case, it would be 20 days to provide it, or would it be as per the FT order?
What do you mean?
Because
See,
so if let's yeah.
FTA, first of all, FTA is going to come back to the taxpayer asking for providing the Arabic translation, right? Information has to be provided. So there is a time limit available in the tax law
Yeah.
for providing the information. Usually it is 20 business days. But if it is a shorter duration, it will be mentioned, but it cannot be impractical. It will be the FTA is always going to give you a reasonable amount of time to fulfill. And if you feel that this cannot be done because of XYZ reason, and if you go back to FTA requesting them to extend the time, they listen considerately, unless they do not, saying that it is clear that you are just buying time. Otherwise, FTA grants.
Okay. So would it be practical to maintain records in Arabic as well,
No, no, no,
just
no.
for an eventuality?
No, no, no.
No.
In UAE, absolutely not. You
No.
can continue. See, in Arabic, I've been here for many years, 26 years now.
Hmm.
Nobody's maintaining record unless, in exceptional circumstance. I have not seen one client in my 26 years who has been maintaining books in Arabic. Okay.
Okay.
So,
Okay.
however, please note that the dominant mode of information submission is Arabic. For smaller things, English works, but if it is a major case with FTA, they may come back to you asking for submission of documents in Arabic, but that will be a case-to-case basis. It will
Okay.
be specifically requested by FTA to provide
Hmm.
something in Arabic, otherwise not.
Okay. Okay.
By the way, this may not be the case in other GCC countries.
All right.
Description of violation: failure of the registrant to submit a deregistration application within the time frame specified in the corporate tax law. Failure of the registrant to submit a deregistration application. If especially for VAT, it is applicable. In case of corporate tax law, very rare circumstances. But in case of VAT, if you have fallen below the voluntary registration threshold of 187,500 dirhams, then immediately you need to file for deregistration. If you don't do that, FTA will not come to you asking you to deregister. The moment you become aware that my revenue threshold has fallen below 187,500 dirhams, within 20 business days you have to file for deregistration. If you don't do that, administrative penalty of 1,000 dirhams will apply in case of late submission of the application, and on the same day, monthly, up to a maximum of 10,000 dirhams. Description of violation, quite a few violations are there, 13 to be precise. Failure of the registrant to inform the authority of any case that may require the amendment of the information pertaining to his tax record kept by the authority. Tax authority said change something, amend something, and you did not do that. One of the following penalties will apply: 1,000 for each violation, 5,000 in each case of repeated violation within 24 months from the date of the last violation. I think it's been 4 weeks. I went to one SME, and they showed me paper notification from FTA, and it was a surprise for me. Why? Because I could see that now FTA's representatives or tax officers have gone to SME level. They are walking in the streets, etc., sometimes in the marketplaces, and visiting shops, SME shops, and giving the notice or penalties right there and then. And they reviewed it, and they saw the invoice, and they mentioned that this invoice, the format is wrong, you need to change it. Once that request has come, that person, that SME, has to take action. If they don't change this, they don't make this modification, amendment, then they'll be fined for 1,000 dirhams immediately. Or if the same similar thing happens within 24 months, repeated violation, 5,000 dirham. Description of violation: failure of the legal representative to provide notification of their appointment within the specified time frame. New shareholders was inducted, and they did not go back to FTA and inform about this, the updating. Is Mr. Momin here on the call? Mr. Momin, can you unmute? Okay, he's so Momin is part of my team, and he has recently undergone, what
Yes,
on, yeah, there has been a recent change in a shareholder, and that he had to go to the Federal Tax Authority to inform that this change in the legal representation has already happened. if we do not inform FTA in time of change in the legal representative, then there is a 1000 dirham penalty that will apply. Description of violation: failure of the legal representative to file a tax return within the specified time frame. How much is the time frame for VAT? Anyone can answer me?
28 days from the end of the.
Yes, from the end of the tax period, 3 months period. So if you file on the 29th or 30th days or any day after that, there is a penalty. 500 for each month or part thereof for the first 12 months, and 1000 for each month or part thereof from the 13th month onward. So you can imagine if you have delayed it for like more than a year or two, we're looking at a good sizable amount of penalty. So, tax return, the penalty shall be imposed from the day following the expiry date of the time frame within which the tax return must be submitted. Now, one very interesting point, though some of you are already dealing with the VAT law and VAT return filing, fine, some company did not know that they were supposed to file tax returns, etc., and there was a gap of 1 year or something. Uh, this is only a penalty for not filing the tax return. What about the money of the all those previous 4 returns that was never paid to FTA? That's a separate penalty, and that can involve time value as well. Let's have a look at it. Failure of the registrant to submit a tax return within the time frame specified in the corporate tax law. Same penalty applies. 500 for each month or part thereof for the first 12 month, and 1000 for each month of delay or part thereof from 13 month onward. Failure to set, yeah, this is a dangerous thing to do. Administrative penalty: a monthly penalty of 14% per month. A monthly penalty of 14% per month, per annum for each month or part thereof on the unsettled payable tax amount from the day following the due date of payment, and on the same day monthly thereof. You can see that there's a percentage penalty of the unsettled tax, 14% per annum. So that is why I told you that example that 6-figure penalty became 7 figures over a number of 5-6 years, I think. Yeah, 5 to 6 years, it became 7 figures. This is a dangerous penalty. For the purpose of this penalty, the due date of payment in the case of the voluntary disclosure and tax assessment shall be as follows: 20 business days from the date of submission in the case of a voluntary disclosure, 20 business days from the date of receipt in the case of a tax assessment. Tax assessment is from FTA. Voluntary disclosure is from taxpayer. But in both cases, 20 business days are there. Within 20 business days, you have to make the payment. Otherwise, get ready for the penalty.
No, small question. This penalty for a per day, like 500 or per month 5.
Let's have a look at it. Which 500 are you talking about? The previous one,
About tax return, yes.
tax return, that's monthly for each month of
Monthly.
delay.
Each month. In Qatar, like a per day 500.
My God, really? Okay.
Yes.
And is it Qatari Riyal? Qatari Riyal?
Qatari Riyal, yes.
Okay.
Yeah, almost same. No, Riyal and the dirham is same.
That is huge, man.
Yes, per
The
day 500.
day 500. The registrant submits an incorrect tax return. What will be the penalty? 500 dirhams. Unless the person corrects his tax return before the expiry of the deadline for the submission of tax return according to the corporate tax law. So naturally, I mean, for example, this is January, right? You filed the tax return right away now for the year 2024, and suddenly in another month, you realize that, oh, we filed the wrong corporate tax return. You can still correct it without penalty until September. Why? Because the deadline for the calendar year 2024 is 30th September 2025. So if before 30th September, if you correct the tax return, there will be no penalty. Otherwise, after that, both penalties will apply: incorrect tax return and underpayment of tax. The submission of a voluntary disclosure by a taxable person in relation to errors in tax return, tax assessment, or tax refund application pursuant to clause 1, 2, and 1 and 2 of the Article 10 of the Tax Procedures Law. So, if if there are errors in the submitted return, a monthly penalty of 1% on the tax difference for each month or part thereof, to be applied as of the date following the due date of the relevant tax return. So, for example, let's say due date was 30th September. So, and you found out the error. So there is a monthly penalty of 1% on the tax difference, 1% per month, and it will be counted from after 30th September. The submission of the tax refund application, the notification. So due date is what will matter. So there is a 20-day period also allowed for notification of a voluntary disclosure. Failure of the taxable person to submit a voluntary disclosure in relation to errors in the tax return, tax assessment, or tax refund application pursuant to tax procedures law. So what will happen? The following penalties shall apply: a fixed penalty of 15% on the tax difference. And number two, a monthly penalty of 1% on the tax difference for each month or part thereof, to be applied as follows. Where the taxable person submits a voluntary disclosure after being notified that it will be subject to a tax audit by the authority, that is a bad call. If you have been notified of the tax audit and after that you submit a voluntary disclosure, the penalty shall be imposed for the period from the day following the due date of the relevant tax return or the submission of the tax refund application or notification of the tax assessment, and until the date the voluntary disclosure is submitted. So that is why that's what I told you when I told you that in the earlier days, voluntary disclosure was being misused, but later on, it was penalized. Even if you do a voluntary disclosure, until the time of voluntary disclosure, a penalty will apply. 1% penalty on the tax difference for each month. Where the taxable person fails to submit a voluntary disclosure, the penalty shall be imposed as of the date following the due date of the relevant tax return or the submission of the tax refund application or notification of the tax assessment. So, if you haven't even submitted the voluntary disclosure, then the due date for filing of the tax return, or when you submitted tax refund application, or if FTA was doing your tax assessment, started doing your tax assessment, when you receive the notification from that day onward, 1% of the difference will start to apply. This is quite harsh. Failure of a person subject to tax audit, his tax agent or legal representative to offer facilitation to the tax auditor in violation of the Article 20 of the Tax Procedures Law, in which case penalties will be due from the person's legal representative or tax agent's own funds as applicable. That's why it is risky to become tax agent. And that's why the tax agents operating in UAE, some of them are, they're onboarding clients in an amazingly risky manner. So tax agent has huge obligations. So the administrative penalty of 20,000 dirham will apply to tax agent or legal representative if they don't facilitate the tax auditor. Failure of a person to submit or late submit a declaration to the authority as required in accordance with the provisions of the corporate tax law. Can somebody remember who was supposed to file a declaration under corporate tax law? exempt persons, right? There are more declarations mentioned. Please revisit the corporate tax law. 500 dirhams for each month or part thereof for the first 12 months, and 1000 dirham for each month or part thereof from the 13th month onward. So that's the penalty for not filing a declaration with the tax authority. And it is not only exemption declaration, there may be other declaration as well. This penalty shall be imposed from the day following the expiry date of the time frame within which the declaration must be submitted. So there is a time frame provided for filing the declaration. If you breach that deadline, after that, these penalties will start to accrue. With the range of the potential penalty headings and the amount or formula to calculate the penalty likely resulting in substantial amounts due, taxable persons should ensure the accuracy of the books and records, and where the outcome of a transaction arrangement is uncertain, either obtain a professional tax advice or they should directly obtain clarification from FTA. I think it is Article 59 which allows obtaining clarification from FTA. There is one more thing, tax assessment, which is Article 20 of the Executive Regulations of Tax Procedures. Notification of tax assessment. Remember what was tax assessment? Unilateral action from FTA, performing calculation of the tax of a person. In notification of a tax assessment shall contain sufficient information regarding the tax assessment and include at least the following: the taxable person's name and address, registration number, reference number, the tax to which the assessment relates, whether it is a corporate tax or VAT or other, tax summary, which includes the details of the tax declared and adjustment made, reasons for tax assessment, net tax due to FTA or refundable to FTA, the date any due tax is payable, and the method of payment. So this will all be included in the notification of tax assessment. The assessment notice is to show all relevant identification information together with the reason for the assessment and the due tax. Where an amount of the tax due to the FTA has been assessed and notified to the person, it shall be deemed a payable debt to the authority and can be collected accordingly. Similarly, there is notification of administrative penalties as well. Similar things fall here. Person's name, TRN, violation for which the administrative penalty has been assessed, the administrative penalty summary, which includes amount of the penalty, amount of tax to which the administrative penalty relates, the total of the penalties due to the authority, the date any administrative penalty is payable, and the method of payment. A little bit on tax.
Sorry, just one small question. When you're discussing all these tax audits, can the taxpayer appeal the audit results basically, or it's not allowed?
Even this procedure has been provided, the time frame that has been provided. And another, if I remember correctly, there's another very tough thing that has been there, that you have to pay the penalty that was imposed on you in order for that appeal to trigger. You have to
Okay.
make payment first, and after that, your appeal will be entertained. In this section, you will learn about tax crimes. Let us have a look at this. Tax evasion penalty. Now, a prison sentence and a monetary penalty not less than the amount of evaded tax and not exceeding 3 times of it, or either of the two, shall be imposed on any person who has committed tax evasion by deliberately failing to settle the payable tax, deliberately understating the actual value of his business or revenues, or failing to consolidate his related business with the intent of remaining below the relevant registration threshold. Abbas, you remember this point? Splitting of the business, tax rate or other tax thresholds, deliberately imposing and collecting amounts as tax without being registered, This is a very serious offense, actually. Some people who are not registered under VAT and they're raising tax invoices, or some people who are collecting the output of VAT but not reporting it, these are serious offenses. Deliberately decreasing the due tax or participating in any form of tax evasion, deliberately committing or omitting any other act which may constitute tax evasion under the mother law of corporate tax. Illustrations of tax crime: deliberately not paying a tax bill, deliberately understanding the business value or revenues, or failing to consolidate related businesses, an artificial separation of business, basically converting one entity into two, etc. This provision is potentially applicable to disaggregating companies in order to breach the tax group rules. So there is uh, tax group rules there is a recent decision, I think decision number 8, right? Recently issued. Deliberately decreasing the due tax or participating in tax evasion, that deliberately committing or omitting any arrangement or transactions, which is tax evasion. So, these were some examples of the tax crimes. Administrative penalty: a prison sentence and a monetary penalty not less than the amount of the administrative penalty, uh, uh, and not exceeding 3 times of it, or either of the two. So there is an administrative penalty that can be imposed, but it can go up to 3 times of it. It shall be imposed on any person who deliberately does not settle a due administrative penalty unless a decision is issued, waiving thereof. So if there is an administrative penalty and the person does not settle it, it can be raised to 3 times. A person who deliberately fails to settle an administrative penalty, even penalties arising from failing to file an accurate tax return, may be given a prison sentence and an administrative penalty not more than 3 times the administrative penalty, which was deliberately not paid. That's a very serious situation. Not exceeding 1 million. A prison sentence and a monetary penalty not exceeding 1 million dirhams, or either of the two, shall be imposed on anyone who commits any of the following acts: deliberately providing false information, data, and incorrect documents to FTA, deliberately concealing or destroying documents, information, and data or other material that he is required to keep and provide to the FTA, not sharing information. False information is number one, that's the worst. Stealing documents or other materials that are in the possession of the FTA, or deliberately misusing or destroying them, right? Uh, Deliberately, this happened in Enron's case, if you remember, famous shredding of documents of Enron. Deliberately preventing or hindering the FTA's employees from performing their duties. A person who deliberately provides false information, all of these crimes can be given a prison sentence plus a penalty not exceeding 1 million dirhams. That's huge. If any of the acts in Article 25 has occurred which resulted in tax evasion or facilitating or concealing tax evasion, penalty set out in Article 25 shall apply. Let us have a look. Any person proven to have directly participated or caused any of the crimes set out in the tax procedures law or the decree law shall be penalized with the penalty described in the procedures law in accordance with the provisions on criminal participation stated in Federal Law number 31 of 2021. Advisors and facilitators, including corporate services providers, lawyers, or licensed managers who directly participate in or cause any of the crimes, shall also be, penalized under Federal Law number 31 of 2021. What is this law? Federal Law number 31 of 2021. Let us quickly have a look. UAE Penal Code. So it is UAE Penal Code. This is UAE Penal Code. Okay. and in accordance with the Article 399 of that law, be sentenced to imprisonment and or fined a monetary penalty. For example, taxable person's accounting firm's senior accounting manager purposely excludes from book profits 25% of the taxable person's revenue for 25 tax period at the request of the tax manager. Both the senior accounting manager and the tax manager, the employee of the company as well as the service provider, are liable to 500,000 tax evasion penalty. If a monetary penalty has been imposed on several accused in one judgment and for one crime, whether they are perpetrators or accomplices, the accused shall be jointly liable for such monetary penalty. So please remember, this is if you are complicit in a crime, you will be jointly liable with the person committing the crime. More than one person liable to monetary penalties for the same offense shall be jointly liable for paying the one penalty. For example, since the senior accounting manager and the tax manager are jointly liable to the 500,000 dirham tax evasion penalty, each will be required to pay 250,000, half. Reoffending is considered an aggravating circumstance, and in the application of the provisions of the tax procedures law and the tax decree law, everyone that has been sentenced by a final judgment in one of the crimes uh, stipulated in Article 25, whatever the imposed penalty is, and then committed any of these crimes before the expiration of 5 years from the date of the issuance of the final judgment referred to, shall be considered to be a reoffender, stricter penalties. Everybody who has participated in a tax evasion crime shall be jointly and severally liable with the person with whom he participated to settle the payable tax and administrative penalties. When more than one person participated in the crime of tax evasion, each person is jointly and severally liable to pay taxes and the penalties. Severally and jointly liable to pay the penalties. Court may, upon conviction, publish the judgment or its summary by a suitable means, and the convicted person shall bear the cost. So even the court proceeding cost shall be borne by the person who has been convicted by the court, on the condition that such publication is upon request by FTA to the public prosecution. There is no requirement for the court to publish any decision, but where it does, at the request of the public prosecutor, the convicted person is to bear the publication cost. So a court does not have a requirement to publish such decisions, but public prosecutor office may ask the court to publish it, and in that case, the publishing cost will also be borne by the convict. The judgment to impose penalty under the provision of the tax procedures law or any other law shall not exempt any person from liability to settle any payable tax or administrative penalties. Shall not exempt any person. The judgment to impose penalty under the provisions of the tax procedures law or any other law shall not exempt any person from the liability to settle any payable tax or administrative penalties. Previously, he already had penalties or tax due. Now new penalties have come in. It does not mean the previous one have gone. Imposition of a court sanctioned penalty does not excuse the taxable person from being obligated to pay the primary tax liability. We are very close to completing this. Procedures and measures, Article 26, written request, criminal case in respect of the crime set out in the tax procedures law or the decree law may only be initiated by a written request of the Director General of Federal Tax Authority, that is. In case of criminal case, a written request has to be made. Without prejudice to the cases in which the law requires confiscation, court may, upon conviction of one of the crimes stipulated in the tax procedures law or decree law, order the confiscation of the seized items and funds without prejudice to the right of the bona fide third parties. So, in short, any assets, items, or funds can be confiscated for such tax crimes under the procedures law or decree law. Before a criminal court case can be initiated, the DG must first have approved, and on conviction, the court may order the confiscation of the seized items and funds. The seizure and confiscating do not prejudice the right of the third parties, like creditors, for example. Seized items. Notwithstanding Article 26, FTA may conduct procedures for storing, moving, attaching, disposing of, destroying, recycling, or selling the seized items where such items are perishable or subject to shortage or leakage, or are in a condition that might endanger the safety of the other goods or facilities they are in. So basically, perishable items court can destroy. That okay, this FTA may conduct procedures. FTA has the authority to destroy such perishable items. Responsibility. Any procedures taken by FTA in respect of seized items shall not prejudice the responsibility to settle the payable tax or administrative penalties in accordance with the provisions of the tax procedures law. Just because FTA has taken the possession of the goods does not mean that the taxable person now does not need to pay the previous dues. They have to. Request item backs. The owner of the seized items has the right to request them back, provided that he has settled the full tax, administrative penalties, and expenses incurred on the items as applicable. Even though goods and monies have been seized or confiscated, the taxable person is still required to settle the due tax and the administrative penalties. So previous dues are not forgotten or forgiven. Once the debt and penalties have been settled, the owner of the seized items can request their return. FTA and its employees shall not assume any responsibility for any damage caused to the seized items as a result of the FTA dealing with the seized items. FTA is not responsible for any damages of the goods that they seized. The executive regulations shall specify the procedures and controls for implementing these provisions on the confiscation and seizure. Article 22 of the executive regulation of tax procedures prescribe these procedures. So these have been detailed in the executive regulations. Reconciliation and tax evasion crime, which is Article 27 of the tax procedures law. Prior to initiating a criminal case, the FTA may reconcile in tax evasion crimes and deliberate failure to settle the administrative penalties stipulated in tax procedures law or in the return for full settlement of payable tax. That's your answer, Abbas. So first,
Okay.
and as well as administrative penalties. FTA may, before initiating a criminal case, reconcile in crimes stipulated in articles of the tax procedures law after settlement of the amounts specified in the cabinet decision on the executive regulation of the tax procedures. First, you have to pay and then ask for reconciliation. The taxable person accused of a tax crime and a deliberate failure to pay an administrative penalty by paying the taxes and the penalties can prevent the initiation of a criminal case. So a criminal case can be avoided if you immediately pay and naturally go for a reconciliation. Also, the taxable person can prevent the opening of a criminal case for breaches of tax procedures law article 25 by deliberating, providing false information, concealing of documents, stealing documents, etc. from the FTA, or deliberately preventing an FTA employee from carrying out the duties. The public prosecution may reconcile in crimes stipulated in Article 27 of that tax procedures law, depending on or before or after a conviction judgment is issued. Before a conviction judgment is issued, public prosecution after initiating a criminal case and before conviction judgment is issued may reconcile the crimes. So this is the process of reconciliation basically, and kind of we can't call it arbitration. It's more reconciliation because it is directly dealt with the authorities. Stipulated in Article 27, in return for full settlement of the payable tax and administrative penalties. I think this is repetition. The public prosecution, after a conviction is issued, may reconcile in the crimes in return for full settlement of payable tax and administrative penalties. I think this also we discussed that both the FTA as well as public prosecutor's officer allow this, but the only thing is the taxpayer has to first pay the due tax and the penalties. Reconciliation in accordance with Article 27 shall be after seeking the opinion of the FTA. Public prosecutor will not reconcile the case after the court hearing has commenced, but before or after the judgment, without firstly consulting the FTA. So public prosecutor, if the court proceedings have started, then public prosecutor will not do anything. They can do it before the start of the court hearings or after the judgment has been issued. Reconciliation shall result in termination of the criminal case. So if reconciliation has been successful, if both parties have reached a conclusion that okay, this is the settlement, then the criminal case will go away, and the annulment of the consequences thereof, and the public prosecution shall order the suspension of the execution of the penalties imposed by the court if the reconciliation is made during its execution, even after the judgment has become final. So that's very interesting that once the judgment has been issued and public prosecution office starts the reconciliation process because the taxpayer has already paid the amount of money of the tax due and penalties, and they come to a slightly different settlement, then even the court conviction will go away and that settlement will override everything. Reconciliation results in termination of the criminal case even if done after the judgment, with the resulting penalties and any custodial sentences being suspended. So the cabinet decision of which is the executive regulations on tax procedures law already specifies the conditions, controls, and procedures for reconciliation stipulated in this article. Tax assessment review requests, Article 28 of the tax procedures law. Without prejudice to the provision of Article 29 of the procedures law, person may submit a request to the FTA to review a tax assessment or part thereof and any related administrative penalties. The request made under Article 28 shall specify the reasons for the request and be made within 40 business days from the date the person is notified of the tax assessment and the penalties. FTA shall review the request made under Article 28 and issue a decision within 40 business days from the date of receiving such request and inform the applicant of the decision within 5 business days. That's when the paper with containing the stamp and signature of the Director General of FTA is received. This is I think reconsideration is next. We'll see. Summary. A taxable person can request a review of an assessment or administrative penalties by the FTA, and the request must nominate the reasons and be filed. So key point here is remembering that there is a 40-day margin available to the taxpayer. But the same 40-day margin is available to FTA as well after receiving the request. Reconsideration request. The person may submit a reconsideration request pursuant to Article 29 of the Tax Procedures Law in respect of the decision issued under Article 28 within 40 business days. This is called the reconsideration request. Once the DG has decided, once you receive that letter, you have 40 days to file a reconsideration request. from the date the person is notified of the decision in accordance with Article 28 or the expiration of the time frame within which FTA is required to issue and notify the application of the decision, it shall not be permissible to submit a request for a tax assessment review or continue to consider it in respect of which a reconsideration request has already been filed. So, there was a tax assessment notification issued. The taxpayer filed a reconsideration request. Then during the course of the reconsideration, those 40 days, another request for tax assessment review cannot be filed. So if you have already filed the reconsideration request submitted under Article 28 shall be made in the form. There is a form available on the Imara tax portal through which reconsideration requests can be filed. So key time duration is 40 days for us to remember. Still reconsideration being continued, a person may submit a request to the FTA to reconsider any decision or part thereof in connection with the person, provided that the request specifies the reasons, that 40 business days. The FTA shall review the reconsideration request and issue a decision again in 40 days. And once that decision has been issued, that communication will happen within 5 business days from the issuing of the decision. It's all repeat. It shall not be permissible to submit a request for reconsideration for a tax assessment if a request for review is submitted to FTA. So also this we read. The request submitted under Article 29 shall be made in the form, that form I mentioned, reconsideration form on the FTA portal. Now we're coming to Tax Disputes Resolution Committee, Article 30 of the Tax Procedures Law. So let's look at the Dispute Resolution Committee. One or more permanent committees shall be formed known as the Tax Dispute Resolution Committee, chaired by a member of the judicial authority and 2 expert members registered in the register of tax experts, to be appointed by a decision by the Minister of Justice in coordination with the Minister. The Cabinet Resolution number 23 of 2018 has been issued on the formation of Tax Disputes Resolution Committees, its relevant regulation and procedures. So these dispute resolution committees, again, the ground reality is you have to pay the money first, and after that you can reach this stage. Permanent committees for tax dispute resolution have been formed as follows: Tax Disputes Resolution Committee of Abu Dhabi, Dubai, and Sharjah. The Sharjah Committee deals with applicants registered in Sharjah, Ras Al Khaimah, Ajman, Fujairah, and Umm Quwain as well. So basically all the northern Emirates. Meanwhile, the Abu Dhabi Committee also attends to foreign companies that have no address in the UAE. Cabinet decision. A cabinet decision shall be issued regarding the committee bylaws, the remuneration of members. So Article 6 of the Cabinet Resolution number 23 of 2018 sets out the functions of the committee. This is a 2018 decision, cabinet decision. What does it set out? Deciding the function. What are the functions of the committee? Deciding the objections submitted against FTA's decision on the mentions for reconsideration, deciding on the motions for reconsideration, deciding motions submitted to the FTA, and FTA does not issue a decision subject to provisions of the Federal Law number 7 of 2017. This is the older version of the tax procedures law. No objection motion may not be submitted to any other committee if it was previously submitted to one committee and that committee decided it. So, once the committee has decided, again, an objection motion cannot be set forth. In summary, the committee reviews the decisions made by the FTA, decides motions submitted to the FTA, and refrains from hearing a motion of the same motion had already been submitted to another committee. So each committee shall be headed by a judicial authority member and 2 expert members registered at tax roll of experts, and a resolution by the minister shall be issued for their appointment in coordination with the Minister of Finance. 3 members are there in the committee. One is the judicial member, others are experts. Tax roll of experts. Each committee shall have one judicial authority member and an expert listed in the tax roll of experts standing by. So there is a register kind of a thing. It's called tax roll of experts. On there, number of experts are listed. And a resolution by the minister shall be issued for their appointment in coordination with the Minister of Finance. Membership period. Membership period in committees shall be 1 year and may be renewed for a similar period or period for not more than 3 years. So 1 year and 3 years. Renewing membership. If the period expires and no resolution is taken to renew the membership, the committee shall proceed its work until a resolution of renewal or reformation is issued. So committee's work only completes when the decision has been made. Very long module. Huh? Jurisdiction of the committee, but these are the easier parts. Committee shall have jurisdiction to decide in respect of objections of the FTA, decide in respect of reconsideration requests submitted to the FTA where FTA has not made a decision, and then any other jurisdiction interested to the committee. The committee shall examine the objection submitted to it and shall decide within 21 working days from the date of receiving the objection. So basically objection to the FTA decisions, basically. Committee may, upon its discretion or subject to the motion of the objector, permit to hold hearings where the objector, his legal representative, or tax agent attends. The committee may decide the motion pursuant to documents provided. So, upon its own discretion or subject to the motion of the objector, permit or hold hearings. So, in short, committee will hold hearings, may hold hearings. Committee may extend the period to decide the objection to a period that shall not exceed additional 20 working days. Original, how long was it? 21 business days. So this is additional. After the expiry of the period stated in clause 1 of this article. So 21 plus 20. Without prejudice to Article 8, the committee may allow the objector to submit any new documents that were not attached to his motion, subject to an excuse acceptable by the committee, or if the committee considers such documents necessary for deciding the objection. So additional information can be provided which was not previously provided. In all cases, tax disputes claims shall not be accepted before competent court if no objection is submitted first to the committee. Tax dispute cases claims shall not be accepted before competent court if no objection is submitted first to the committee. So basically, court works on the working of the committee. If there is a no objection submitted to the committee first to the committee, the court will not accept this case. At the hearing, the committee reviews the objection and reports within 21 business days, may permit the objector additional 20 business days. This is a summary repetition. Procedures for submitting the objection and cases of non-acceptance. This is Article 32 of the Tax Procedures Law. Submitting the objection. An objection to the FTA's decision in respect of consideration request shall be submitted within 40 business days. From the date of being notified of the FTA's decision. An objection submitted to the committee shall not be accepted in any of the following instances if a reconsideration request has not been previously submitted to the FTA. So that's a very important point. In the hierarchy of procedure, first is the reconsideration request, and after that committee stage will come. If the tax in connection with the objection has not been paid in full, if the objection is not submitted within the period specified in Article 32, meaning that 40 days period. So if you have not done that, then the committee will not entertain the request. Let's look at the objection motion shall be submitted to the competent administration. It is not to be submitted to the Department of Tax Dispute Resolution Committees at the Ministry of Justice via the online objections system. Not to be submitted. Sorry, it is to be submitted to the Department of Tax Dispute Resolution Committees. So there is a portal in the Ministry of Justice through which these requests can be entertained by the committee. The objection shall be submitted according to the form determined for this purpose, provided that it shall include the following documents and details. So particulars will be provided: name, address, etc., summary of the subject motion and other motions submitted, supportive documents, etc., electronic addresses of the legal representative, tax agents of the objector, any other documents that may be needed with the reasons. The objection can be submitted electronically through the FTA system and is to be submitted using the form issued for this purpose, and that form must identify the objector's details, summarize the objection and the motion. This is a, in your practice careers, what we are studying right now, you may come across this, not very frequently, but this is a very technical area, and it is a very high paying area as well. An objection shall be recorded in the registers prepared for this purpose according to its date of submittal. So objection shall be recorded in the register with a date. The objector shall get a receipt of the objection submitted or objection submittal that includes number of objections and the competent committee that shall hear it. So details of the objection shall be there with numbers. Competent administration shall send the objection of the competent committee within a period that shall not exceed 2 working days following its submittal day. So committees shall be informed within 2 days. So committee procedures and decisions. There is a Article 33 of the Tax Procedures Law. The committee shall review the objection submitted to it and make a decision within 20 business days from the receipt of the objection. Committee shall inform the person submitting the objection and the FTA of its decision within 5 business days of the decision. This is only the window of informing. This is the window of making a decision. The committee's decision on the objection shall be deemed final if the total amount of due tax and penalties do not exceed 100,000 dirhams. In all cases, disputes will not be accepted before the competent court if an objection has not been previously submitted to the committee. So as I was mentioning the hierarchy, first the reconsideration request, then the committee, then the court. That's the hierarchy. An appeal to the court is not possible from a committee decision where the aggregate due, tax and penalty does not exceed 100,000 dirhams. For example, the committee rejected the taxable person's appeal since the disputed tax was only 50,000 dirhams. Taxable person is unable to appeal. Then in that case, committee is the final tier. Enforcement of the committee's decision, Article 34. Final decision issued by the committee regarding disputes that do not exceed 100,000 shall be deemed as executory instruments. It can be enforced. The decisions issued in disputes exceeding 100,000 dirhams shall be deemed as executory documents if they were not appealed before the competent court within 40 business days. So that's the limit. Once the committee decision has come, there are only 40 business days available from the date of the notification of the objection without a right to appeal from less than 100,000 dirhams, decisions deemed enforceable as are decisions involving in monetary amounts exceeding 100,000 if not appealed within the 40 days. So for 100,000 dirham cases, committee's word is final. If it is above 100,000 dirham cases and you did not care about those extra 40 days available with you to go to the court, then even in that case, you will lose the right to go to court and committee's decision will become final. The final decisions of the committee, which have the power of executory instruments, shall be enforced through the execution judge at the competent court. So court will enforce the decision of the committee. So still there is an extension of deadline, Article 35 of the Procedures Law. FTA or the committee, as the case may be, may for any of the reasons specified in the procedures regulations may extend any of the periods specified in articles of the tax procedures law for a period specified in the executive regulations. FT or the committee, as the case may be, may, at a request of the person for any of the reasons specified in the law, grant the person an extension of any of the periods that have been provided in the tax procedures law. In short, extension is possible. FTA can give some extra time to the taxpayer. The decision by FTA or committee refusing the request for extension shall be final and not subject to an objection or appeal as the case may be. So different articles have been given, but we have gone through the contents of these articles. So I'm not going to repeat these. Procedures of appeal before court. So now we come to the last level of appeal, which is court, making an appeal. Without prejudice to the provisions of the tax procedures law, the FTA and the person, as the case may be, may appeal the committee's decision before the competent court within 40 business days, as the case may be, or the person was notified of the committee's decision in any of the following cases. Objecting to the committee's decision in whole or in part, then you can go to the court. Non-issuance of a decision by the committee regarding an objection submitted to it in accordance with the provisions of the procedures law. You remember how many days the committee can issue the decision? 21 days. And then there was additional extra days also possible, 20 business days. But within this time frame, committee did not issue a decision. Then the aggrieved party can go to the court. Appeals from committee's decisions may be made by the FTA or the taxable person against the whole or portion of the committee's decision, or if the committee doesn't issue a decision. Both cases, we can go to the court. Ruled as inadmissible. The competent court shall rule the appeal against FTA as inadmissible in the following cases. Existence of a case of non-acceptance of an objection by the committee. Because due to any reason, committee said that we cannot accept your case because it was already decided by another committee, for example. Then in this case, court will not entertain. If the person does not present a proof of settlement of full tax to the FTA, if the person going to the court does not pay the money first, the entire money of the proposed penalty, you can't go to the court. If the person does not present a proof of settling at least 50% of the administrative penalties determined pursuant to the committee's okay, hold on a second. This second clause was tax, not penalties. If the person does not present a proof of settlement of full tax to the FTA, and this was for 50% of penalties as well, of the administrative penalties determined pursuant to the committee's decision or the court's ruling, as the case may be, through cash settlement to the FTA or by providing an approved bank guarantee in favor of the FTA. That's very interesting. So, the company did not pay the entire money, but the lawyers told them that, look, your case is very, very strong. So do one thing, don't pay the money, but take a bank guarantee and provide it. So that bank guarantee will also work, and the court may entertain it. Amends. Cabinet may, at the suggestion of the minister, make the necessary amendments to these articles of the procedures law. At the end of at the date of the writing, no such amendments are published. This is the summary. Court shall not permit an appeal of a committee's decision where committee didn't accept the case. Secondly, person is unable to confirm that they have paid the full tax plus the penalties and at least 50% of the administrative penalties, or issued a bank guarantee. Special procedure for objection and appeal. As an exception to the provision of Article 31 and 32, 33, 34, 36, there is an exception. The cabinet shall, at a suggestion by the minister, issue a decision adopting an alternative mechanism for objection and appeal if the parties to the dispute are any of the federal or local government entities specified in that decision. This facilitation is only for the government bodies, not to the ordinary taxpayer. Pending the Cabinet's decision and its enforcement, the provision of the Tax Procedures Decree Law shall apply to the objection or appeal of the federal and local government entities concerning tax disputes. Statute of Limitations, Article 46 of the Tax Procedures Law. Except in cases under Article 46, the FTA may not conduct a tax audit or issue a tax assessment to a taxable person after the expiration of 5 years. So there are certain exceptions to the 5-year rule, Mr. Nauzer, from the end of the relevant tax period. This means that except in special circumstances, the statute of limitations is 5 years from the end of the relevant tax period. For a taxable person's 31st December 24 tax period, the statute of limitations bars the tax audit commencing from 1 January 2030. 5 years are allowed. Notification of the commencement. FTA may conduct a tax audit or issue a tax assessment to the taxable person after 5 years from the end of the relevant tax period if he has been notified of the commencement of such tax audit procedures before expiration of 5-year period, provided that the tax audit is completed or the tax assessment is issued within 4 years from the date of notification of the tax audit. So FTA may conduct a tax audit after 5 years as well, but that limit is but the completion of the audit has to happen within 4 years from the date of commencement. The tax audit may continue after the 5 years, providing it was commenced within the 5 years, but must be completed no later than 4 years from the date the FTA notified that an audit was to commence. So, in another scenario, audit started within the 5-year duration of statute of limitation. So it can continue after 5 years as well, but the maximum time duration of completing that audit is 4 years from the start of the audit. So there is an example given. If in the above example, FTA notified the taxable person on 1 December 2029, if you really think about it, the year was 2024, right? So 2025, 6, 7, 8, 9. We had only until the end of 2029 when the statute of limitation would expire. But on 1 December, FTA informed that we are going to start the audit. Okay. But the audit did not commence before 1 February 2030. Notification came. The audit must be completed within 4 years, which is by the 1st December 2033. So that date of notification will be counted and we'll add 4 years to this notification date. That's when the tax audit must finish. Voluntary disclosure. The FTA may conduct a tax audit or issue a tax assessment after the expiration of 5 years from the end of the relevant tax period if such tax audit or tax assessment issuance relates to a voluntary disclosure submitted in the 5th year from the end of the tax period, provided that the tax audit is completed or the tax assessment is issued, as the case may be, within 1 year from the date of submission of the voluntary disclosure. So a lenient treatment has been awarded to voluntary disclosure. So in the 5th year, some poor tax taxpayer submitted a voluntary disclosure. FTA may start a tax audit in the 5th year. But in that case, because of the voluntary disclosure, that audit must finish within 1 year. The tax audit may continue after 5 years, provided that if there was voluntary disclosure within 5 years. The statute of limitation had not finished, and the taxable person made a voluntary disclosure within that 5 years. Now, it can continue beyond the 5th year, but the maximum time duration again is 1 year to complete that tax audit. Example is given. If the taxable person notified the FTA of voluntary disclosure on 1 December 2029, then only 1 year will be allowed. That means 1 December 2030, it has to finish. Although this date, 1 December, lies outside the statute of limitation deadline. The cabinet may, according to the session of the minister, issue a decision to amend the period specified for the completion of the tax audit or the issuance of the tax assessment as per the tax procedures law. At the date, nothing is provided for that. Another point is no voluntary disclosure may be submitted after the expiration of 5 years from the end of the relevant period. So even the taxpayer is barred from submitting voluntary disclosures. In case of tax evasion, tax evasion is a serious case. Authority may conduct a tax audit or issue a tax assessment within 15 years. That's huge. So if there is evidence that tax evasion has happened, then statute of limitation is extended to 15 years from the end of the tax period in which the tax evasion occurred. So same thing, like the tax evasion was 25, so 15 years until 2040, the tax audit can happen. In case of tax registration failure, authority may conduct a tax audit or issue a tax assessment within 15 years from the date on which taxable person should have registered for tax. The same thing goes. So non-registration can also be challenged within 15 years from the time when they should have registered. FTA and committee authorities' right to claim payable tax and administrative penalties of which the taxable person has been notified of do not lapse within the time, and the FTA may claim them at any time. We're going to skip quickly. In case a period of time is not specified for the performance of any obligations or other procedures in the tax procedures law, FTA shall grant the taxable person a period appropriate to the nature of the obligation or procedure of not less than 5 business days and not exceeding 40 business days from the date of the event. So what are we talking about here? Period for tax obligation. In case the period for the time is not specified, so minimum time granted is 5 days, maximum is 40 days. Controls for paying by installment, waiving refund, etc. So if the FTA imposes or collects administrative penalties from the person for violating provisions of tax, the committee provided Article 50 may, according to the presentation of the Director General, issue a decision approving the payment by installments of the penalty amount or totally or partially waiving off refunding it pursuant to the controls and procedures issued in a decision by cabinet according to a suggestion by the minister. At the date of writing, no such decision has been made. But just for informing you, for other scenarios, this is available. You can, for example, the car fines in UAE, you can convert it into installments. Same thing goes for the tax obligations. It is quite possible to convert it into installments. Chairman of the board shall issue decision forming the committee provided for Article 50 to be chaired by him or his deputy and the member of two board members. The decision issued forming the committee shall set out its bylaws and the manner of holding the meetings. Accuracy of data, that's easy. Burden of providing the accuracy of tax return falls upon the taxable person. Key point, that it is the taxable person who is required to provide accurate information. Finally, we are on the knowledge check. So, first question, true or false? An example of an arrangement based on the general anti-abuse rule would be where steps are taken to ensure that meetings of the board of directors of a company are held in a different country in order to claim that the company has changed its residence, that's tax residence. One transaction alone may result in a benefit, or it may operate in conjunction with more elaborate series. I think this is true. Okay. Second question. Select all that apply. Abbas, I need your help, and Mr. Nazar, your help. Let's click it. If a determination is made under Article 50, the FTA must issue an assessment giving effect to the determination, which may include, this is assessments basically, which may include allowing or disallowing any exemption, deduction, or relief in calculating the income or the corporate tax. I think this is correct.
Yeah.
Allocating any such exemption, deduction, or relief or any part thereof to any other person. It was allocating. It was not allocating, it was allocating to another person. I don't think this is correct. Recharacterizing the purposes of the decree law for the purpose of the decree law, the nature of any payment or other amount, that is absolutely correct. FTA can recharacterize interest into dividend for two shareholders. Disregarding the effect that would otherwise result from the application of other provisions of the decree law. I am not sure of that. Disregarding the effect. Yeah, it was Abbas, it was there, right? Disregarding the
Yeah, I think so.
that would otherwise result from yeah,
The
the
applicant.
person was applying FTA disregarded. Yes, it was there. Making compensating adjustments to the corporate tax liability of any other person affected. Yes, I think this was also there.
Yes.
Let's check. Ah, correct. Third one, select the correct response. Okay. According to voluntary disclosure, Article 10, Tax Procedures Law, taxable person is required to voluntarily disclose to FTA that the tax paid by reference to the taxable income disclosed on his return or the tax on the tax assessment underestimated the corporate tax which should have been paid. So underpayment of tax to FTA. The disclosure is
Compulsory.
compulsory. Okay. Next one. Select the correct answer to complete the following statement. The voluntary disclosure for underpayment of tax due to filing an incorrect return by less than 10,000 dirhams is how many business days of becoming aware of the errors?
20.
20.
Correct. Fifth one. If a taxable person becomes aware that a tax return submitted by him to the FTA or a tax assessment sent to him from the FTA is incorrect, resulting in a calculation of payable tax according to the tax law being less than required by not more than 10,000 dirham, the taxable person shall. Is this so there is a difference of less than 10,000 dirham. So this is the lighter version. So that what does the taxable person need to do in that case? It's not a compulsory disclosure then, right? So let us read through. If the taxable person is obligated to submit a tax return to the authority, correct the error in the tax return that has not become due for submission for the previous tax periods, or in the tax return for the tax period in which the error has been discovered, whichever is earlier, that is correct. It was there. Submit a voluntary disclosure to the authority within 20 business days from the date of becoming aware of the error. In the event that there is no tax return through which the error can be corrected according to paragraph of this paragraph, I think this is also correct.
Yeah.
And then deduct corporate tax or account for it. The deduction of corporate tax is only mentioned in Article 45. Deduct corporate tax for it. Hold on a second. If a taxable person becomes aware that a tax return submitted to him or the tax assessment is incorrect, resulting in a calculation of tax payable according to the tax law being less than 10,000 dirham. Yeah, so deduct corporate tax or account for it. The deduction of corporate tax is only mentioned in Article 45 for withholding tax to be deducted. But this is what? This is under Article. Okay. What do you think I should do with this? When the person becomes aware, I think
I think we ignored this.
we ignore this.
Uh, I think so.
Hmm.
Huh?
And say that if a taxable person becomes aware that a tax return submitted by him to the FTA or a tax assessment sent to him from the FTA is incorrect, resulting in a calculation of payable tax according to the tax law being less than required by not more than, so the amount of error is not more than 10,000 dirham. The taxable person shall, I think we have to select this. Let's see. Because it's an action. Maybe you're right. Let's see. Incorrect. Submit a voluntary disclosure. Yeah, this one was not. You're right. You were right. Let's go to the sixth one. Select all that shall apply. When the FTA decides on whether or not to conduct a tax audit on a person, it shall consider the following. Yeah, I think burdens and it's that a tax audit is necessary for protecting the integrity of the system. Absolutely, it was there. The responsibility of the person or anyone associated with him to comply with the law, this was there. The likely tax revenue, this is also there. I think this is all correct. Yeah. Then the next one is 7. Let's see. Select the correct answer to complete the statement. The tax auditor is given very dash inspection powers. The items the auditor can inspect under Article 2 provide only documents and procedures which the taxable person should have available for inspection. I think the answer would be wide
Right.
powers. Okay. Let's read the eighth one. True or false? FTA is required to provide the following 3 types of information. Required to provide. FTA is required to provide the following 3: internal information, confidential information, and requested information.
All false.
And then ninth, select the correct answer to complete the following statement. According to tax crimes and their penalties, Article 25 of the law, if a monetary penalty has been imposed on several accused in one judgment, that example, 500,000 dirham fine, 2 people are involved, they have to pay equal fine to 250,000, 250,000, accused in one judgment, and for one crime, whether they are perpetrators or accomplices, the accused shall be jointly. This is the answer, correct?
Yes.
and we ask select all that shall apply. According to the request for reconsideration, a person may submit a request to the FTA to reconsider any decision or part thereof issued by FTA in connection with the person, provided that the request specifies reasons within 40 business days. The FTA shall record the reconsideration request, shall review the reconsideration and issue the decision, including reasons within 40 business days from the date of receipt of the application, and inform the applicant of the decisions within 5. This is also correct.
Correct.
40 business days, take the decision, and in 5 days it will form. And then what is the next one? It is permissible to submit a request for reconsideration of a tax if a request for is submitted to the FTA in this regard until a decision is issued by FTA or the expiry of the period during which FTA must issue a decision. I think it is not permissible. Should have been here, isn't it?
Not permissible. Not permissible.
Not permissible. Not permissible.
The request submitted under Article shall be made in the form. Yes, this is correct. Yeah, so correct. Okay, so that's it. Very much for you. Inshallah, next Sunday is our last lecture for completion of this. Thank you very much. Take care. Bye.
Thank you.
Thank
Bye.
you.